Morning, everybody. Drew, aka Catching Rockets here. I hope y'all are well. I hope y'all are having a good weekend so far. Um, so today I'm going to be doing a class basically going over what I think is the way to go from either like brand new to trading or if you're already trading but you're not profitable, how to try to get there. So, oh, and also, sorry for starting late. I was listening to music, hyping myself up before the class, and then I didn't realize what time it was, and I'm like, shoot, if I'm going to be teaching for 3 hours, I need to get my dogs fed and make my wife coffee and all that stuff before I start. So let's see. I'm going to start out really basic. If you're new to trading, we need to understand like basic market structure. So like higher highs, higher lows, higher highs, higher lows, higher highs, right? So this is how the market generally moves. We're either going to have an uptrend where we're making new higher highs and new higher lows, or sideways price action where price is chopping back and forth. Personally, I love trading this. It's really easy. And then lastly, we'll have downtrends where we have new lower lows, lower highs, lower low, lower high, lower low. This might seem really basic, and that's okay. Excuse me. I don't know what's going on with my voice today, but it's probably going to be an issue. If you don't understand this stuff, like I'm not going to go into too much detail right with all of this, but if you don't understand this, you need to read this book. I just linked it in the chat. For people watching this later, these books will be linked in the description of the video. But so this is Getting Started in Technical Analysis by Jack D. Swagger. And let me just pull it up on the screen so everybody can see it. And for people that aren't new, we're going to be moving along quickly. This is just for people that are new. So this is where you want to start. You don't need to memorize this book. There's a ton of information in here, mostly talking about chart patterns, things of that nature, but you really want to have an understanding of it when you go to trade in the market. We can look at, specific examples. And like I said, this is going to, for people that are really new, like this is going to progress very quickly to a point where you might feel a little bit lost, and that's okay. This is not a race. But I'm laying out, like, if you're brand new, start by reading this book. Again, don't need to memorize it. Read the book, and then all of the stuff that I'm talking about will start to click and start to make sense. While you're reading the book, I would say, or while you're reading, while you're studying, while you're learning, I would say don't trade. Feel free to invest, meaning buy shares, buy mutual funds, buy ETFs, but don't trade. Once you've learned the information, at that point is when you want to start, considering trading. So we need to understand, like our basic market structure, uptrends, sideways price action, downtrends. And then we also need to, learn how to get into trades based off of that information. We can zoom out on SPY right now. Basically, we're going to do a little bit of market structure stuff really quick. So this here is a downtrend, right? And this is a daily time frame. So here, I don't know that I have a tool to mark higher highs and higher lows, but there might be. But so up here, wow, that's kind of ugly. I have a higher high. Why is it going all sideways? This here would be a new lower low, right?
There's that indicator.
What
High,
is
high,
it?
low, low. Hold that.
I'll just draw them. It's okay. Here we have a higher low, right? Wow, sorry, this is funky. I don't know why it's like doing stuff all weird. I guess maybe I'll use the indicator. That's really strange. This maybe? Okay. It's missing some, but that's okay. So like this is a higher high. This is a, well, I guess it's based on the current. Yeah, so this is kind of missing for me. Let's, not a big deal, but basically I'll just use my arrow tool since drawing that was really funky. So like this here is a higher high. And then we come down and we make a new lower low. We make a new higher low. Lower low, higher low. Lower low, higher low, and this would be the low. So hopefully that makes sense. But so this is our downtrend right now that's happening. I guess I missed this point, but it doesn't matter. You guys get the idea. And then if we kind of look at this, and again, if this doesn't make sense to you, it's okay. Read the book on technical analysis. You're going to want to understand basically, and again, we don't need to memorize it. Oh, and also, I should just apologize. I decided to do this class, I think, on Thursday, and I worked Thursday night, Friday night, slept a little bit in the afternoon on Saturday, did some stuff with family on on Friday, and didn't really have time to like put together like a solid presentation, which I would normally do when I'm doing a class. But more importantly, I just want to get the information across to you guys. So this isn't going to be seamless and nice like when Shorty does it. He has his PowerPoint he uses. We are going to reference his PowerPoint, but his PowerPoint is not in it's not in an order probably that I'm going to go. And I don't want to do basically exactly the same class that Shorty does. Hopefully that makes sense. But so this is kind of what we're looking at. Whoa, hang on one second. Sorry. Where is... I just realized that's not going to be like zoomed in enough. Okay. So you want to understand all of the chart patterns. I'm not going to go through all of these individually. Too much to cover. And you guys need to do some of the work yourself, which is, reading the books. If I tried to do a class from, 0 all the way to advance, we would be here for days. So we're going to touch on the points that you want to, learn and focus on. And then you guys, need to put in the work on your own. But so right now, well, sorry, let me go back to this really quick. I got ahead of myself. Right now we're looking at, it's probably like a bear flag, or possibly like a bear pennant, which they don't have listed on here. But if we look at this, this is our flagpole here from the top to the bottom. And again, we're not going to focus on this stuff too much. We're going to get through this pretty quickly. And this would be the top of our flag. And this here would be the bottom of our flag. And to me, bear pennant in the sense that normally if we were looking at a flag, it would be more shaped like this, if that makes sense. Whereas this is kind of forming like a triangle at the bottom, right? Thanks, Cheekster. I appreciate that. The main point that I want to focus on with this is when we have patterns like this, and I don't trade them really very often because market makers are aware of these chart patterns, and they will specifically do things to, or they'll specifically like make it look like they're about to break out of the bear flag, and then they'll reverse and go back, grab people's liquidity, and then they'll make the move. And so what we teach on this channel is trading off of volume profile, things like that, things that the market makers can't hide from us. And that way we're able to make better, more informed trading decisions. Personally, if I am trading a flag, I'm always looking at getting in at the top. Whereas most retail, the minute like we break the bottom of the flag, they'll get in. Some people, like let's say from here, we come back up to the top and then we break the flag here. Some retail will wait. So some get in here on the break of the bottom of the flag. Some will get in here on the break of the last touch of the flag. And some will get in at the bottom, basically after we break the bottom of the bear flag. And then just for reference, if it's a bull flag, it's just going to be the inverse, okay? With this, the main thing that I want to touch on is when you have flags like this, they're measured moves. And so you draw your fibs from the bottom of the flag to the top, or if it's a bull flag, you would draw from the top to the bottom. And that's going to give you your fibs, and your first target is going to be here, the 1.272 fib. Second target would be the 1.618. Third would be 1.786. When you're getting down into these, like you're in a major downtrend, but generally you would want to be closing your position at the 1.272 level. If we go on a lower time frame, or actually, let's do this because I always love looking at this. I don't know why. Is it net? I spotted this bear flag. I don't even remember when. This is 2022 that this was forming. And so here we have a massive bear flag, right? If we draw it, it's something like this. And here is where we broke. And then the top of the flag is, I don't know. Doesn't really matter. We'll just say it's this. But it looks more like something like that, where it looked like they were going to reverse out of it, but then they didn't. This is our flagpole here. And if we draw our fibs, again, flagpole bottom to top, we get our 272 here. And then you can see, actually, I guess they didn't quite tap it, but we came really close. And I mean, this is a massive move. We're talking, actually, let's just measure it instead of like trying to figure out numbers. Almost 40 points that they lost here. So these measured moves work. If we go to like Amazon, we're going to talk about another type of measured move. You can look at Amazon even on like monthly candles, I think. And here we had like the biggest consolidation that I think I've ever seen on a chart. I'm sure there's bigger ones, but just nothing that I've actually noticed before. But so if we look at this range here, we spent 639 days in this range here, meaning that for 639 days, price was trading in this range, back and forth, back and forth, back and forth, back and forth, until we finally broke. This is also a different type of measured move. Again, I don't trade based off of measured moves, but it's important to understand what to expect, basically. And you can see there was some fake outs where we were trading in this range. They faked out, looking like they were going to go break out above. They came back inside, faked out again. And then even here we had fake outs on the downside. Here we got a pretty big move down, retested, and then made the move. On sideways price action like this, and actually we can even like, I don't know. You kind of have to decide where you think the top is, where you think the bottom is. It could be this. It could be this. I don't think either is wrong. But if we clone this box and move it down below, when we actually finally do break, the measured move would be equal to the size of the range that we were trading in. So if we broke above, you would expect price to come to the top of this. If we break below, you would expect price to come to the bottom of that box, which is exactly what they did once they finally made the breakout and went. Right? So just be aware whenever we have, like sideways price action like that, we're going to be looking for a measured move to the downside. So right now, like if we look at the daily on SPY, we were trading in this range up here for quite a while, right? And then again, like the same thing where you have to figure out kind of where the top and the bottom is. For argument's sake, I would say the top is probably right around here and the bottom is right around there. And we've been in this range now for 119 days. And then you see we lost the bottom. And if we clone this box, it looks like we've completed the measured move, and we have. Just barely, and they bounce from there, right? So again, good to know basically like where our price targets are based on things like, whatever, bull flags, bear flags, sideways price action where we're consolidating in a range. When we have sideways price action like this, consolidating in a range, you're really expecting like a pretty big move to the upside or to the downside, because they're either accumulating to go higher or they're distributing to go lower. But so a lot of things, but you guys can look a lot of it up, have measured moves like head and shoulders, things of that nature, double bottoms, double tops, pennants. It's been a long time since I've drawn this stuff, but again, I don't trade off of this, but you want to understand it. So like if you have a pennant, we'll just say this is a pennant instead of a bear flag. Normally you can draw your fibs. Oh, sorry. I just have to remember if it's, so it's this way. And then on a breakout, like your first price target, same thing, is going to be the 272 level. And then your second target, your 618 level, and so on and so forth. Okay? So you just want to have an understanding of how those things work. And so that would be the first book, Technical Analysis by Jack D. Swagger, or Getting Started in Technical Analysis by Jack D. Swagger. I'm going to pivot from here and focus less on chart patterns and things like that, and get into more of how I actually trade, which is volume profile and volume order flow. But we're not going to go too advanced, meaning we're going to talk about volume profile, and from volume profile, actually, maybe I'll just explain it right now. If you're new to trading, or even if you're not new to trading and you're struggling as far as becoming profitable, I think there's a few key things that you should focus on. One being trading off of just volume profile alone. And basically I'll say three things: volume profile, your Sigs, which is basically a part of volume profile as well, and then also TPO. So, and I'll explain this more as we go more in depth, but like, you basically want to understand where your poor highs are, poor lows, signal prints, and spikes are on your chart. And that's what you want from TPO. SIGs are always good because as we get further away, to the far extremes of our bell curve, we're looking for reversals. And so understanding where those pivot points are on the chart is good. Yes, we will definitely touch on risk to reward. And then volume profile will give us like good areas to use, basically to find entries to take trades. And again, I'm going to be giving you guys several books to read, and basically what I recommend as far as trading, like when you start, or if you're already trading and it's not working for you, we're going to go over some psychological stuff that you can implement into your trading to hopefully get to that profitability point. Okay? This coffee mug my wife got me. El Jefe. All right. So quickly, let me see. I don't think I have anything of importance on this chart. I'm just making sure. Yeah, let me erase all of this. So now we're going to start getting into volume profile. Before I start, when we're trading, we need to invest in ourselves. For TradingView, I understand like it's not cheap, but that's part of what we have to do if we're trying to become a trader. So I pay for annual premium, and I would recommend getting premium, but I would also recommend waiting until they have a sale. So basically what all of us do, like in Shorty's Discord, or I think a large portion of us, not everybody, I can't speak for everybody, is like every Black Friday, I always make sure I cancel my subscription. It doesn't stop your subscription right away. It will keep going until your expiration date, but I always cancel it, that way they don't automatically bill me. And then on Black Friday, when they have their sale, they also have sales like different times of the year. And I think there's also ways to like get them to send you promotions. Like if you sign up for 1 month and then cancel your subscription, they'll generally send you like a promotion for a pretty deep discount. Or you might be able to find like discount codes on the web. I'm not sure, but basically every Black Friday, I'll pay for this, and I think I pay like half of what this cost is. It's like $350, something like that. And the premium is pretty important because that gives you access to TPO, which is pretty important. I mean, you can trade without having access to the TPO indicator, The only issue is like you have to try to figure out on your own whether it's a pour high or a pour low or a single print. So that can be a little difficult, but it is doable, but way better to have the TPO or to have access to the TPO indicator. And then this is like non-negotiable. If you're trading any indices, you have to have the US stock market bundle. It's like $10 a month. If you're trading futures, you have to have CME Globex. If you don't have either one of those things and you try to chart what I'm about to teach you, your levels will be off and you'll never have correct levels. And also, your data is going to be 10 minutes delayed. And it's pretty hard to trade with a 10-minute delay on your charts. Okay? So, when we're starting with volume profile, like a brand new clean chart, we start on the daily candlesticks. And we're going to use a indicator. And I'm just going to do this like I don't have... Actually, let me just delete everything, basically. I'm going to go from scratch like I don't have any indicators. You would just type in PVP. Or if you want, you can type out periodic volume profile. And we're going to be using this indicator quite a bit. And under our settings for PVP, there's only a couple of things that you need to change. So your value area volume is going to be 68. And your row size is going to be 100. Not 1,000, 100. Under style, you want to check value area high, value area low, POC. I tend to color code these, but you can do whatever works for you. And then on our PVP indicator settings, under inputs, we're going to go to period 12 months. And what this is going to give us is it's going to give us our yearly levels for volume profile. And basically what we're looking at is this range here from this blue line to this blue line is 68% of the volume that was traded during the year. So it's the highest percentage or of our total volume, 100%. This is the 68% that was the largest amount, or the area where we traded the most. And so what we're looking for with this is basically we're going to draw a line. And the reason we do this is when we change time frames, these levels will actually move. So you want to have your levels on your chart. That way when you're trading on different time frames, our levels are still accurate. And while I'm talking about time frames, because this will definitely come up for people get really hung up on like what time frame do you trade on. And really the way I look at that is it doesn't matter. Basically, if you're or at least it doesn't matter for the way that I trade. So if you're trading off of volume profile and you're trading off of, previous week value area low, previous week value area high, or previous day value area high, previous day value area low, so on and so forth. Once I have my lines drawn, if I change to a lower time frame, those levels don't change. So let me just draw this out really quick, and then I'll explain what I'm talking about, or I'll show what I'm talking about. And when you first chart, there's quite a bit to go through. But once you have your chart done, like your higher time frame levels and stuff like that, it starts to get a lot easier. Because you're basically just Monday through Friday, or I should say Monday through Thursday, you're just moving your daily levels forward. And then on Friday, you'd want to move your weekly levels forward. And then once a month, you're going to draw your monthly levels. And once a year, you're going to be drawing your yearly levels. Also, something that I will add is, let's just say price on SPY does this. And now we're trading down in this range down here. We're below the 2024 value area. And we don't have yearly levels down here. We want to make sure that we would add our 2023 levels to our chart where price is currently trading within. Okay? And that would apply to basically any of your levels. So like if you don't have monthly levels for a certain month and we're trading in that range, you want to make sure you put those monthly levels on your chart. Okay? From here, we're going to go to a 4-hour chart. Still using the PVP indicator, but we're going to change this to 1 month. Sarah, I think your mic is hot. Just a heads up.
I have a question.
Oh, go ahead.
So for futures, when you chart futures, does it matter if you're on RTH or ETH?
So, good question. I was going to cover that a little bit later, but we can talk about it now. So what I'm going over right now, I'm using regular trading hours because we're charting SPY. If you're trading futures, which actually I recommend for everybody, I would say anybody that's trying to trade options, you're not profitable, switch to futures. It's way easier. You don't have to worry about Greeks. You don't have to worry about theta decay. And using stop losses and take profits are much easier because the price is the price. With options, you're always guessing because you're trading off of the value of your contract. So like, let's just say you bought a SPY contract for $100 and you're trying to target, like, I don't know, let's just make up a scenario. Like, let's say your entries here, your stop loss is the 2024 value area high, and you're targeting your take profit up here. And you're trying to guesstimate what the value of that contract will be at 606.37, and you just really have no really solid way of doing that. Whereas if I was trading futures, and this is made up because we don't trade futures on SPY, but let's just say I'm targeting 606.37 on futures. I literally just put my take profit at 606.37, and when that level is touched, it'll close me out of my position, and I'll take my profits. If it came down and hit my stop loss at 559.47, when it hits that level, it's going to stop me out, and I'm going to lose on that trade. So with that said, for futures, we always chart on extended trading hours. The only exception is for TPO, you're going to trade on regular trading hours. Anything that's not a future, we chart on regular trading hours, and we also chart TPO on regular trading hours. Okay. So now on our monthly, right now March is still developing, so we wouldn't draw our March levels. What we do want is our monthly levels. As a bare minimum, we want our previous month. So we would grab the low here, the POC here, and the high here. And I know I haven't talked about POCs yet. I'll get into that in just a minute. And then all of my stuff, you can see I have templates saved and they're color coded. You don't have to do that. But color coding it makes it easier for me to, like, at a glance kind of know what I'm looking at. And then this is going to be my February levels. So that would be my February value area high. February POC. That's double spaced, which is annoying. and my February value area low. Again, like I said, right now I'm nowhere near February, right? So I would want to, at a minimum, have my September levels on my chart, which is where we're trading right now. For time's sake, I'm not going to draw that because I'm not going to be teaching you guys trading, based on where we're currently at. We'll just find scenarios and setups to explain those things. But so again, at a minimum, you want like your previous month. If you're far away from that price and you have a value area that's, where we're currently trading within, then you want to make sure you have those levels on your chart. And then you can see here, like we basically bounced at the September value area low, right? So as price is coming down to these key levels, you want to make sure you have them on your chart. And from here, when we bounced, we came up, we retested the 2024 value area high, bounced from there, and then we retested it again, and we're bouncing again. So make sure that you have these key levels on your chart when you're trading. Once we've drawn our monthly levels, we're going to drop down to a 65-minute chart. If you don't have 65 minutes on your trading view, you just go up to add custom interval and you would just type in 65 and then minutes. The reason we use 65 minutes is the New York Stock Exchange is open for 8.5 hours every day. And if we're using 1 hour, it's not divisible by 8.5. If we use 65 minutes, that is divisible by 8.5. And for this, it's going to give us our previous week levels. And here, basically, under our settings on PVP, we switch to 1 week. And then, actually, this is going to give us a couple of good examples. So let's just pretend we're here. And this is our current previous week going into the next week that we just finished trading, basically. We're going to grab our low. We're going to grab our high. And then we're going to grab our POC. And then throughout the entire week, so Monday through Friday, we're going to be trading off of these levels, as long as price is within these levels. And then after Friday, so like right now, it's Saturday morning, we're going to need to move our previous week levels forward to the current previous week. So this is what I was talking about. Basically, once a week, all you have to do is move forward your levels. So you just grab your low and move it to the new current low. And this would be Friday afternoon after the market closes, or anywhere, you can do it Saturday or Sunday, but you definitely want to have your levels ready before the market opens on Monday. And so once a week, you just have to do that. One key thing I'll also point out, when you have two levels like this that are really close together, you can just combine them and do something like that. Okay. So there's our previous week levels. From here, we actually switch to a 30-minute chart. And we're going to go to our indicators and type in SVP, or Session Volume Profile, and add that to our chart. And then on our settings, we're going to go value area volume 68, row size 100, just like we did for PVP. Under style, we're going to check value area high, value area low, and POC. Once we do that, it's going to give us our previous day levels, and we're going to do the same thing I just was showing you. Let's pretend Friday hasn't happened yet, right? And so right now we're charting Thursday for Friday. We would go previous day value area low, previous day POC. Whoa. And then previous day value. Oh, so sorry. I got to turn off my PVP indicator. It was like throwing me off because I had lines overlapping everywhere. It was kind of crazy. And then my previous week value area high. So again, once I've done this, this would be for trading on Friday. And once Friday finishes, so basically once a day, I'm just going to move forward my daily levels like this. And basically from day to day, charting is just about that simple. You're moving forward a couple of lines, and then you want to use your TPO. So you just type in TPO or time price opportunity. And under your settings, you can turn on whatever you want, really, like pour low, pour high, single prints, inputs. Ticks per row, I think, is 4 for SPY. You can also just leave it on automatic. It's really kind of up to you. But sorry, I'm waiting for it to load now. Oh, wait, this is 1 week. I don't want that. 1 day. So sorry, we want to make sure we're on 1 day. It's still loading. My tick size might be too big. Okay. So I guess this is kind of good because on Friday we had a spike. And basically what TPO is if we go to our settings here, go to style and expand blocks. How do I wish I could change the opacity inside of the value area as well, because that would be really helpful. But we'll work with this. Basically what this is if you look at these candles, so we're on a 30-minute time frame, and each candle is 30 minutes, obviously. And then each candle is represented by a letter. So we have like the A period, the B period, which would be the second 30-minute candle, the C period, which would be the third 30-minute candle, D, E, F, so on and so forth. Right now, I think so. It just doesn't want to load if I do custom. Okay. So right here we have the A and the B period that came basically in the same range. And so this here, since we have two candles in this block area, this would be considered a pour low. And that basically just means that we have two or more candles that came down into this level. Actually, I think I should backstep. I think I'm going too quickly forward, and we should finish just with volume profile. We'll get into TPO after we explain volume profile a little bit better. Sorry about that, everybody. So again, volume profile, what we're mostly looking at is the 68% of the volume that's traded on a given time period, depending on what that... Robinhood, you're crazy, bro. Depending on, what that range is. It could be a previous day, previous week, previous month, so on and so forth. We're looking for where 68% of the largest amount of volume was traded. And then our POC is going to be the point of control. The point of control is where the largest amount of volume was traded on any given time frame. So in this case, we're looking at the previous day POC. And you can see it's labeled as a VPOC, which just basically means it's a virgin point of control. And what a virgin point of control is while this point of control is forming, so basically from the beginning of our day on Friday to the end of our day on Friday, this level can be touched as much as it wants to. Because basically, like, if we were saying a virgin point of control could never be touched, then virgin point of controls wouldn't exist. Because we're looking for the area where the most volume is traded on a given time period. And that level has to be touched for volume to be traded in that area, right? If we turn on extended trading hours, and let's just say we're looking at this day, Thursday. Sorry, let me go backwards. And let me turn off extended trading hours. This will all make sense in just a second here. So for Thursday, my virgin point of control is here. Where are you? Now, if I turn on my extended trading hours, from when it starts being formed, Thursday morning, all the way through the end of our, pre-market, it can be touched as much as it wants to be, and it would still be a virgin point of control. Because again, it can't be formed unless it's being touched, right? So, because that's the area where the most volume is traded. Once the market opens on Friday, if price goes through this, then it's no longer a virgin point of control. It would become just a regular POC. The key to this is virgin point of controls are about 10 times stronger than a regular POC. And when I say 10 times stronger, what we're looking at is if we have... Basically, they act as price magnets. So if we go back in time and we look, we have a virgin POC here. And if you're going to put these on your chart, the way that I would do it is say... this is our 320 virgin POC. And again, you don't have to label your stuff this way. This is just how I would do it. You do what works for you. And then down here, we have a 318 virgin POC. Down here we have 313. And then you can see, so this is a good little tip. My session volume profile is only going back as far as December, right? So if I want to get levels back here, then I can hit the replay mode and go backwards. And then it'll start drawing my volume profiles, further back. And then if I want to go even further back, same thing, replay mode, go back. And then I can start getting my virgin POCs over here. I don't know that this is still a virgin POC, but as of this point on the chart, it is. So this is September 18th. This here is September 12th. And then this here is going to be September 11th. This is, just as an example, like this here was a virgin POC. So this was formed on Friday. It was a virgin POC Monday, Tuesday, and then Wednesday, right here, it got touched and would no longer be considered a virgin POC. For daily levels like this, once it's touched, I would just take it off my chart. And then basically, like, you can keep going. Like, this would be another virgin POC down here. This is another virgin POC down here. This is another virgin POC down here. And basically, when we have, if we start looking at this, so we have a virgin POC right here at the top. Three, 7. We have another one here. I believe that's it. Oh, and then there's one way up here at the top. So if we look at this, right now, I have 1, 2, 3, 4. Or no, I'm sorry. 1, 2, 3 virgin POCs to the above where price is currently trading. And then if we look down, I have, okay, so we didn't know if this one was still virgin or not, and it's not. So we got to erase that one. Well, this is a virgin. I don't know why it's not. Oh, sorry. Yeah. And then below, what is wrong? I drew these. I'm so confused right now. Oh, I guess there isn't any. Okay, we need more. So, virgin POC here, August 12th. I guess if we're going to do this, we need to do it right and draw all of them. Okay. So now, if we look above price, we have 1, 2, 3, 4 virgin POCs. Right? Yeah, 4. And if we look below, okay, these are not. We have 1, 2, 3, 4 to the downside. And then I could probably, so there's going to be more over here. Basically, let's see, let's go there. I'm trying to prove a point here, and it's making it very difficult to prove. But that's fine. We'll work with it. Okay. So again, above we have 4, right? 1, 2, 3, 4 virgin POCs. To the downside, we have 1, 2, 3, 4, 5. And again, if I'm doing this accurately, you know, like I could keep going and find there's going to be more over here. There's going to be more in this area here. There might be some here, more down here. And basically, since virgin POCs act as magnets to price, if we have 4 above and 6 below, more likely than not, those virgin POCs are going to be pulling price back down to clean those up. So that's just kind of how you want to think about it. They're not always going to get cleaned up. Like we could go way back on SPY and probably find virgin POCs from a while ago that never got cleaned up. But just a general rule of thumb, they're going to act as magnets to price, and they'll try to pull price towards them. Hopefully nobody has any questions on virgin point of controls. The biggest key thing to remember is, again, we'll look at Thursday for this. Or actually, I won't do that. What am I doing? If we go to extended trading hours and we're looking at Thursday's VPOC, for this whole, you know, again, they can be touched while it's being formed. Once it's formed, pre-market, post-market, pre-market, it can keep being touched. It's during the regular trading session that if it gets touched there, that it would no longer be a virgin POC. So hopefully that makes sense to everybody. I see some questions in the chat, so let me just look at those really quick. Thomas, yes, the stock market, like you're paying for your live data is completely different than your monthly subscription to TradingView. Yeah, bum me, there are ways to do that. It's also not like... unless things have changed with like Thinkorswim, it's not super accurate. I used to try doing that and it didn't work too great. How do you change TradingView profiles so the chart drawings don't overlap? I don't know what you mean, Robin Hood. AG805, this is 12 months. If you're talking about when we were drawing our yearly levels, yes, it's 12-month period. Melanated, I'll answer your question in just a second, okay? And I'll also give the specific book that you want to read. Oh, so Daryl's saying, how do I extend my levels just to the right? So You're probably using this line here, the horizontal line, which goes both directions. I'm using the horizontal ray. So over here, you have your horizontal line and horizontal ray. The horizontal ray just goes from the point to the right and not left to right. Hawk Girl Stocks, do you have live data? Because that's going to affect it. Okay, so Melanie had asked to touch on what the value area is, and that's a very good question. I'm just going to use Shorty's PowerPoint for this because it's going to say better than what I will. As soon as I find it. Am I on the wrong? No. Shorty's added volume, or he's added footprints to his volume profile. Okay. Volume profile is an advanced order flow indicator that displays volume distribution at price over time using y-axis instead of the typical volume bars on x-axis. So y-axis is basically volume at price, so volume this way, versus volume at time, which we have down at the bottom here. Okay. Don't confuse volume profile with market profile. Market profile shows how long price traded at each level. Volume profile shows how much volume was traded at each level. Depending on the number of contracts traded at each price level, the shape of the distribution will vary. The more trades, the longer the length of the horizontal line, while a short horizontal line represents little trading. We've already covered this, but you can always go back and pause the video and read this if you want to. This is, again, really like something that you'll want to read through. But this is talking about basically what volume profile is. We're looking at the 68% of the volume traded, which is our first standard deviation, like on a bell curve. The 95.4% would be like our second standard deviation on a bell curve. And then the 99.7 would be our third standard deviation on a bell curve. Again, if you want to read through all of this, just feel free, go back, pause it. But so this is what volume profile is. And then from here, we want to also, actually I should have covered this first. Sorry. Again, this is like the lack of preparation thing. So let's just use this as an example, I guess. We want to look at volume profile, basically like rungs on a ladder, so, or shelves on a stair. So anywhere where we have a large amount of volume traded, so like this area here, you can see there's a shelf of volume, right? And actually, let me hide our candlesticks so it makes things a little bit easier to see. This area here we would look at as like a stair or a rung on a ladder where price can sit, and it has something to support it. And then we have like another volume node here, and we have another volume node here. And then through here we have what would be considered like a skinny belly. And then up here we have another large volume node. And so the way that you want to think of this is anywhere where you have like a stair or a rung on a ladder, price can sit comfortably. So like here, if we just think of ourselves like walking up a staircase, right? If I decide that I'm tired and I want to take a rest, I can stand on this stair for as long as I want. And then I could step up to the next stair and again, stay there as long as I want. I could go back down to the next stair, so on and so forth. Come up to this stair here, hang out. But when I try to go here, there's nothing to support me, right? So I can't hang out in this area here because there's nothing for me to stand on, right? So when we have skinny bellies like this, generally price will quickly fly through there and go to our next stair on our staircase, and then again, price can hang out there. So this is kind of how you want to look at volume profile. And if we turn our candlesticks back on, oops, went one too far. And we move forward on this replay here. So I don't know that price comes back up to here. Okay, it does. So here you can see, price was comfortable here. If we go to like a lower time frame, it'll probably look better. But so here price could hang out comfortably like we were talking about. Here price, there was some pretty significant selling. And then price came back to here and it was able to hang out. And then we came back up here. We're hanging out. Back down here, we're hanging out through here. Sold off, came back to it, tapped it basically, and then sold off again. And then you can see here, like price was able to hang out through here, but through our skinny belly area, price moved really quickly, right? So if price was to go back up to here, we would expect price to go quickly back up through to this area. So that's how you want to look at volume profile, is basically like either stairs on a staircase or rungs on a ladder, where at those key levels where you have volume, price is able to hang out there. And where there's no volume, there's nowhere for price to hang out. It's just going to fly through it. Okay. Robinhood. Yeah, you can have more than one. So here you can create new layouts right here. So like I have 4. So Hawk Girl, you're saying that your POC doesn't line up, and then you're talking about CME group, which is for futures. So for your stocks for indices like this, you need to have the New York Stock Exchange, NASDAQ, ARCA, OTC bundle to be able to have the levels correct on SPY. Okay. Bun me, that PowerPoint is only available to people that are in Shorty's Discord. It's not mine to give away. Yes, Bun me, the larger your volume shelf is, the more, like basically, the more price is going to be able to hang out there. I'm trying to see, like, does Shorty talk about different profiles? I don't think he does. Or I'm sure he does, but... But basically, there's a few profiles that we want to look for. So let me hide my... my candlesticks again. We're looking at mostly, like... I'm going to identify the main ones. Like, this is a lowercase b, right? I don't know why I made that so funky. Let's try that again. Lowercase b. And a lowercase b is generally indicating more downside, right? The next, like, main type of volume profile we're looking for is going to be our D-shaped profile, which is generally just sideways price action, right? From there, we're looking for capital P, and these are generally just going to be continuation for higher prices, or like it could be a reversal. So like here we have a P at the bottom, and you can see from here, like, price reversed from there up. Okay. The only other really, only other main profile that you look for is going to be like your B shape, which is a double distribution. Capital B, meaning that there's, they were trading sideways through here, and they were also trading sideways through here. Okay. Sorry, let me start erasing this stuff really quick. All right. So the next link for you guys, everything that I'm talking about, you're going to find in this book, Volume Price Analysis. This is the link to that book. Again, they're also linked in the description of the video down below. And so you want to make sure that you read these books. And if we pull up Volume Profile really quick, the book, it's not a long book, and it's actually very interesting. So this is Volume Profile by Trader Dale. Really nice guy, actually. He's actually, like, accessible where you can email him, or well, you could probably talk to him on Discord. I've never tried, but you can email him and he'll reply to you. Nice guy. But this is, his book explains a lot of what I'm covering right now. And I kind of talk about this too on my channel a lot. Like, I'll tell people, like, you don't need to pay for Discords for, to learn how to be a trader. You don't need to pay a mentor to learn how to be a trader. You don't need to buy courses from other people to learn how to be a trader. So, like, here on my channel, we do market analysis. Like, we look at SPY, whatever. We look at ES. And we'll go over what we think we're looking for the next day as far as areas to enter trades. And then we also do classes. Like, we're doing a class right now, mostly on Volume Profile. We learn this information somewhere, right? Like, I didn't just suddenly go, hey, like, and develop volume profile, I don't think there's anything in trading that hasn't been discovered. I could be wrong. Like maybe somebody finds like the next amazing thing. But for the most part, I think like the people before us really figured out like chart patterns, candlestick patterns, volume, order flow, footprints, things of that nature. And we can learn from them, right? So people that are creating courses, they learn from these people that I'm talking about, and then they made their own course, and then they're trying to sell it to you at a way inflated price. So like this book is like a $10 book. Or you could even just go to, let me show you here. You can literally just go to traderdale.com or trader-dale.com. And he does sell courses. But if you go to volume profile, you'll see it says instant download. And it's no BS, right? You click it, it's going to ask you for your name, it's going to ask you for your email address. And I'm sure the reason that he does that is he'll then send you emails like, hey, Drew, like, blah, 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 whatever. You can always unsubscribe if you don't want his emails. Me personally, like, I like physical copies of books. So, like, right here I have... Sorry, I got too much crap on my desk, but... As an example, right here on my desk I have Trader Dale's book on order flow. And I'm definitely like a practice what I preach person. So anything that I'm teaching you guys, anything I'm talking about, books that I'm recommending, I've read them. I don't just blindly recommend stuff. But so yeah, like, sorry, I'm trying to put this book back under all this crap. So anyway, you can come here and you can see like I have the PDF. So I went to his website, I put in my information, I downloaded it. I still get his emails. They don't bother me. Like, he'll actually send like trade setups that he's looking at. So I don't think the emails are super intrusive or anything like that. But you can come here and you can literally get it for free, or you can go to Amazon and buy it for $10. If you want order flow, same thing, put in your name, email address, and you'll be able to instantly download it. Stock investing with volume profile, same thing, click it, put in your name, email, and download it for free. He's like the only author that I know of that does that, but he is also trying to sell courses and sell like his trading tools, like for Ninja Trader. With that said, if we go to page 25, this is where you do want to memorize. So starting with strategy 1, support becoming resistance and vice versa, you would want to memorize this information. And basically, we're talking about support, breakthrough support, come back up to it, turns to resistance, you would enter short or grab a put. Inverse, resistance, breakthrough, become support, enter long or grab calls. His next strategy, the open drive, I'm not going to go over this too much, but you want to memorize all of these things because like these are the entries that you want to trade based off of. Sideways price action, big move, either up or down. When we come back to that area where the move happened from, you would enter in the same direction. This would be the market open. So like the New York open plus an open drive where we had a big move down, came back to it, you would enter from that same point. This is the inverse of the previous one where sideways price action, big move up, come back to it, enter long or enter calls. AB equals CD. I don't really trade off of this, but you might like it. So read it, learn it, understand it. and again, I think page 25 through like I think it's 45, you really want to memorize. This next strategy, daily, weekly, high, lows. This is the daily high, price broke through it, come back to it on the retest, enter long or enter calls. Daily low, break through it, come back to it, enter short. This looks like it would have been a fail in my book, but that's not important. I think, actually, while it's on my mind, when we're looking at trades, it's less important to be right, like showing a setup, because when we're trading, we're just trading probabilities, and the more that you remember that, the better you're going to be as a trader. The trade's not always going to work, right? There's nothing, as far as trading's concerned, that's 100% accurate. Like you might have a setup that's like 80, 90% accurate, but it's still going to fail time to time. So when we do look at setups, looking at one that didn't work out is not a bad thing. We do need to figure out like where we want to stop out, where we want to take our profit, things like that, which we'll talk about a little bit later. Strong highs, lows, or weak highs, lows. This is something that you want to learn. And we'll talk about that a little bit later. So like this is a strong low where price came down and then we got a really strong reaction from there, right? This would be a weak low where we came to here, tapped this level, bought it back up, and then came back down to it again, and then went. So like this would be the distinction between a strong low and a poor low. Strong high here, where we came up, tapped it, price went away from it, didn't come back to it. Weak high, where we touch it, sell off. When price comes back to here, you would expect it to break above and go higher. This is important to know. Where you have a strong high, you don't expect price to come back to there. And if price does come back to the strong high, that's where you would want to grab puts. And I can show you an example of that from yesterday. Like if we look at ES. Is this it here? Where is this Friday? Yeah. So if we look at Friday here, if we go back, let me actually just erase this. Would everybody agree right here, we have a strong low, right? Any arguments? Price came down, got sent pretty high, right? If we advance back to Friday, when price came back to there, if you grabbed calls, or in this case, we're looking at futures, longs, and let me just try to make this realistic. Let me do this because I don't like all of the noise. I know this isn't my current previous day value area low, so I want to move this as well. This is my current previous day value area low. So kind of looking at the information that I have, if I was taking this trade, I'd be wanting to close it in this range here. And basically what I'm looking at is as we came down to here, this acted as support, then we broke through. When price comes back to here, it's probably going to act as resistance, right? So if I'm taking this trade long here, or if I'm grabbing calls, for example, first thing I want to identify like my entry. So let's just say I got in at the top of the box because I didn't want to miss the trade. So 5,652. So I go long right here. And then let's just say I'm targeting the bottom of this next box, right, as my take profit level. The next thing I want to figure out is where do I want to stop out? And for me, I've got to look left. There's not a whole lot of information. But at a minimum, I think I would want my stop loss to at least be above. So, sorry, let me move this out a little bit more. I wonder if I go further back. Yeah, so even if I move this back here, right, this is like a pretty key level where I have resistance, and then here it gets broken above and becomes support, right? And then we break back below, it becomes resistance again. Break back above, it becomes support again. So to me, this is like a key level where, based on where we're trading, I would want my stop loss to at least be below this level, right? So, and the reason I say below it is, let's just say they try to do a liquidity grab, and the market makers go, like most people might be looking at 5,648.75 based on what I just showed you guys to the left as the area that they want to stop out on their trade. And they go, well, if I'm going to use that, like to grab people's liquidity, I can't just come down to that level and then go. I actually need to go a little bit lower, grab their stop losses, and then go, right? And so that's how I do my stop loss. Like, I look for like key levels where like support's turning to resistance or resistance is turning to support. And then I say, like, okay, my stop loss needs to be a little bit below that, because if they're doing a liquidity grab, they're going to go through that level and then go. And so then the next thing that we need to look at is, on my trade, I need to be able to make at least $2 for every dollar I risk. And here my risk to reward ratio is $2.54 for every dollar that I risk. So this is a trade that I can take. So based on this level, and this is like live real stuff from Friday, we have that strong low here, and if we trade it off of that level Friday, if we turn off the replay here, we can see, well, actually, let me also turn off my initial balance, just kind of clean this up so you guys can see better. There we go. If I took this trade based on what I said, obviously, like, yeah, price went higher. I could have been riskier, and like I could have targeted the top of the box or whatever. But if I'm just looking for a nice, good, clean trade, based on what I showed you guys using just support and resistance levels, this would have been a great trade. And if you take a trade like this, like, just to give you guys an example, for futures, if we measure this, this is 15 points, and we're risking $5.75. So the actual math on that is I'll do the entire math, but every point on ES is $50. But every 25 cents, so futures, or at least ES, sorry, moves in 25-cent increments. So you can see, 52, 52.25, 52.50, 52.75, 53, so on and so forth. So every 25 cents equals $12.50. So, and this is for ES, right? So if we take this $12.50 multiplied by 4 gives us $50, which is our, like 53 to 50, or sorry, 52 to 53. So every dollar move equals $50. If we multiply that by 15, if you took one contract, you made $750. And to make $750, we were risking $575. So we risked $287.50 to make $750. I'll take this trade any day, all day, every day, no questions asked. And I think everybody can agree, like, we're not doing anything super crazy here. We're finding key levels, strong low. The next time we come to that, you enter the trade. And then I just used like the next key support resistance level as my exit, right? And technically, well, you wouldn't have known it at the time, but like this was our kind of our entry for calls or for longs. But like I was saying, with strong lows, we typically don't come back to them. I mean, eventually, yes, but like Trader Dale talks about in his book. Sorry, I'm trying to go back to it here. You actually want to close your position before the strong high because they're generally going to reject before that. And you can see he's kind of using like this consolidation area here as the place to close the trade. I would put mine a little bit lower. It's kind of hard to show, but where this was broken through and this red candle here like bounced off of, that would kind of be the level that I'm looking to close, or possibly even this wick here on this green candle. I might close there. But that's me as a trader. Okay. So what I was trying to show you guys is like he's saying you want to either get into the trade before the bottom of this because they're generally not going to come back to there, or you want to close your trade before the bottom of this because they're generally not going to come back to there. If they do come back, we're going to get a reaction like this where we get like a really nice bounce. And you can see like this was the reversal point on Friday. We almost retested it, and then we made like a new higher high, came down, and then rocketed from there. And you really could have just, depending on how you trade, like even if you said long from there and close somewhere in this range, you'd make a bag. This is, let's just use this one, like 33 points. If you were trading like to the bottom of this here, 41 points, like, yeah. So this is kind of what you want to look for. Again, read Trader Dale's book, memorize this stuff. And I want to say basically you want to memorize through page 45. And where we have like a weak high or a weak low, you actually expect price to break through it. So he's saying common mistakes, trying to take a short at a weak high or take puts. Most likely price is going to break through this and go and make a new higher high, or closing your long position here, since there's a very high probability that price is going to break through this and make a new higher high. This here, he's talking about pin bar candle with a long wick. This is aggressive selling right here. There's another word, and it left my mind for whatever reason. Stopping candle. That's what I was looking for. Stopping candle meaning that's like from here we're going to reverse and go in the opposite direction. So he's talking about from this stopping candle, basically when we come back to there, you would enter short. But yeah, so 25 through 45, you really want to memorize in volume profile. Okay. Moving forward. I think like if we're just looking, again, like at a large time frame, this here is a strong low, right? And if for, whatever reason we get into puts here and we're trading this down, again, you're not expecting price to come all the way back to here. So you want to like basically say close here. If you're less risk adverse, like close here. And if you guys are paying attention, I'm not just randomly picking levels on the chart. This is basically the top of these bodies of these candles right here that I chose for this level. And this level here is the bottom of the bodies of these candles, or the top of this candle, this wick. So again, this is resistance, resistance, broken through, support, support, support. We broke through it again, became support again. This would not be a terrible spot to close your trade, right? Because there's a chance that we bounce from here because we have this strong low, right? Again, saying close here, you're not wrong in either scenario. It's just how much risk you're willing to accept on your trade. Okay. And then up here, what we were talking about when we were looking at Trader Dale's book, this here is a poor high, right? And then these are just going to reverse. So like this is a strong low. If this was a strong high, same thing. If we were in a trade, we would want to get out before we got to the strong high. Like here's an example here, strong high. If you were to be in calls here, you would want to exit before, because as you can see, the high is kind of right there. So we didn't make it back to that strong high. And again, kind of the same thing again. If this is me, I'm looking at this range here to close my trade if I'm in there. Okay? So you always want to pay attention. Do I have a strong high? Like if you're in calls or if you're in long, do I have a strong high? Yes. Then I want to close my trade before I get to there. Then you need to figure out like where it is that you want to close your trade. Or do I have a weak high like I do here? And the answer is yes. Then you would actually be expecting price to break through this and go higher. But again, of course, this weak high formed after this bounce here. So we haven't retested this level yet to see that they're probably going to break through it and go higher, right? Right here we have a poor high, and this is Friday. So if price heads this way, like Monday, I would not be surprised to see them go and break above this and make like a new higher high. Okay? Hopefully this is making sense to everybody. Always be aware when you're in a trade. Do I have a strong low? Do I have a strong high? Do I have a poor high? Do I have a poor low? If you have a strong high or a strong low, you need to close before you get to those points, because most likely price will reject before it gets there. Do you have a poor high or a poor low? In which case you would want to be in the trade. Like if this was a poor low, you would want to be in the trade because we're probably going to break through it and make a new lower low. If I have a strong high, we're probably going to break above it and make a new higher high. I hope everybody's following. But so all of this again is from the book Volume Profile by Trader Dale. This is the only book that I'm going to be talking about today, where I say, like, memorize basically 20 pages, page 25 through 45. You want to memorize those setups, and that's what you want to trade based off of. You don't need to use, like, we've been drawing levels based on our yearly levels, monthly levels, weekly levels, and so on and so forth. You don't even have to do that if you don't want to. I trade that way, but you can literally just look at the chart and say, like, actually, let's kind of go back to where we were. So here, this was our strong low. When we came back and retested it, and then again here you can see we have a poor high, so you expect price to go higher. We retested it. This would be where you would grab calls or grab longs and trade it up, and then from there you need to figure out where you want to close the trade. For me, I would kind of basically be like looking at this, where this is support, and then we broke through here, got our strong low, we have a poor high. This is your entry for calls or longs, and then I would expect this to act as resistance, which it didn't, which is fine. So we actually went higher, but I would be closing my trade here because that's the safe play. When we broke above it, it became support again, and then we broke back through it, it became resistance here. How I trade, so like if I have this as a level on my chart, I'm generally looking for like a break like this, and then a retest, and then I enter short. And when I'm looking for a break and a retest, I want to see like 3 5-minute candles or more below my level. So in this case, we broke below. This is my first 5-minute candle. And this is a really, really good example that I'm about to show you guys here. When we broke through this, it was clean. And then when we were below it for the next 2 candles, so again, my first 5-minute candle, or in this case, it's a 30-minute candle, but it doesn't matter. This is such a clean setup. We're just going to show it. We can pretend these are 5-minute candles. It doesn't matter. But again, we want 15 minutes below or more. So in this case, it's like 45 minutes below, and that's fine. We got 15 or more, right? So our first candle below, second candle, you'll notice we never wicked back above. It opened and closed below our level. Our next candle, same thing, opened and closed below our level. And then our retest, and as you can see, like this is so clean, where we barely tapped the level and then we rejected from there, right? And kind of the same thing, if I was taking the short, I would be targeting something like this here as to close my trade. Again, we're just looking support, broken through, turned resistance, broken through, acted as support again, blah, 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 so on and so forth. If you're being more aggressive, you could target like the bodies of these candles here and the wick of this candle there. Really just up to you at that point. But for me as a trader, I would be closing here. And then obviously, we went lower, and that's fine. For me, I'm looking for the key levels where we're switching from support to resistance, because the next time we come here, I expect it to act as support. It didn't. That's fine. But then you can see even over here, like I wasn't looking at this when I drew this line, but we broke through here. We came back to it. This is our retest where you would enter short or enter puts, right? And so this just repeats over and over and over again. You find those key support and resistance levels, and that's it. Thanks, Melanated. I appreciate that. And again, like, even if, let's just say, even if we broke here, right, we come back to it, and they did something like this, I would still be happy to show it to you. And I can't emphasize this enough, we're trading probabilities. They don't always work out. It's so important to be able to take the losses. I'm going to talk really quickly right now about psychology. We're going to go into psychology more in depth as we finish up this class or towards the end of the class. But there's a lot of traders, and this might like touch home for a lot of people when I say this. There's a lot of traders that they can have like 2 weeks of wins, just win, and they're doing really good. And then they take one loss, like let's just say, I don't know, what's a good example? Well, it doesn't matter, but let's just say they tried to take puts here or whatever, and it ends up bouncing and stopping them out, right? They took 2 weeks of like just win, and then that one loss, they can't accept it. So then they immediately enter into another trade thinking, let me make back the money that I just lost on that trade. And then, of course, since they didn't wait for a good setup, they take another loss. And then they go, well, shit, like, let me just hop in here because it looks like we're still going to continue higher. And here happens to be there. And then they reverse and go back down. And then they get stopped out a third time. And then they're like, well, fuck. Well, like, if we're going to keep going down, you know, like, let me get in short here. And they try to grab shorts, and then it reverses and it goes back up and stops them out a fourth time. And before they know it, everything that they made over the last 2 weeks, they lost in one day. And potentially more. And sometimes those people will just even completely blow their account. And it's all in one day because they didn't show discipline. They let that one loss affect their entire mentality to the point that they started chasing trades and FOMOing. And, Leo, that's happened to me a bunch of times. If it hadn't happened to me, I wouldn't be able to talk about it, you know. But once you learn how to not do that, that's when you finally become a trader and finally start making money trading. That would be called boom and doom, where you're like boom, 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 winning, and then in one day you just wipe everything out. Happens to a lot of people. Let me just erase a couple of things. All right. Yes, this is TradingView. For me, TradingView is a must if you want to be a trader. There's just no getting around it. It's not cheap. It's also not terrible. But like I kind of said at the beginning of the video, if you want to be a trader, you need to invest in this. Like, you have to put money in to make money. There's really no way around it. So you need to pay for the subscription for TradingView. And then you also need to pay for live data. And anybody that's interested, I mean, most people are probably going to have TradingView accounts. If you don't, there's a link in the description of the video. It is an affiliate link. If you use that, both of us get like a free month, I think it is, or something like that. I would get a free month of subscription, and you would get a free month of subscription as well. But not necessarily, that's not why I'm doing this video. But basically, anytime that I share a link that's an affiliate link, I like to specify, hey, this is an affiliate link. But you don't need to click my affiliate link. You can just go to tradingview.com and sign up through there. But if you do want to give me a little kickback, that would be one of the ways to do it. So, sorry, I'm just trying to gather my thoughts on where I want to go next. Yeah, no worries, melanated. Um, and again, to be clear, let's just look at this really quickly. Here we have a poor low, and I want to talk about this a little bit more as well, like the difference between poor lows versus strong lows, and poor highs versus strong highs. So here where we have a poor low, like if we just draw a line to the right, you can see the next time we came here, we broke through and went lower, right? Inverse, here where we have a strong high, price didn't quite make it up to the top of that, right? So here's the top. We came up and we actually like rejected pretty hard without making it to that same level. One of the things that, or one of the ways that I explain this is, if you think of this here as a door, we'll just say, I don't know if I can draw a door, but if this was a door and I'm a police officer and I come to your door with a battering ram and I hit it once and your door is so strong it sends me flying, right? The next time I come with that battering ram, your door is going to send me flying again, right? The inverse, if your door is not that strong, and I come to your door with my battering ram, and your door is so weak that I can hit it, get a little rejection, and then hit it again, then the next time I come to that door with my battering ram, I'm probably going to break a hole through it, right? And then I'm going to hit it again, I'm going to punch through it again, hit it again and punch through it again, and then finally like just bust all the way through it, right? So that's how you want to look at like your poor lows and poor highs is like a weak door where I hit it and my battering ram just barely rejects off of it and I'm able to smack it again. I'm eventually just going to smack right through it. Whereas a strong high or a strong low, it sends me flying so far away that I'm barely even able to come back and smack the door a second time. Okay? Hopefully that makes sense to everybody. So just to clarify, we just talked about this where, shoot, I wish I had the example again. I don't know why I erased it. That was kind of stupid. It was so nice. We'll just use this here. So when I break through a level, I'm looking for 3 5-minute candles or more below. And then when I retest, I would be looking to get in short or get into puts, right? And if you're really paying attention, it might not be obvious on like this time frame here, but when we're looking at this, this is basically a bear flag, right? But the difference is we're not waiting to get in on the break of the flag like retail. We're getting in at the top, right? And then I'm going to show you guys a good example of this where this didn't work. And I'll kind of show you how they fake out retail. So if this is our bear flag and we get in at the top on the retest of our whatever 3.7 POC, and take it down from there. And then if we draw our fibs, right, our profit target 272, are we golden? Did we get out nice and clean on this trade? It works, right? So when you identify like a bear flag like this, or even a bull flag, where we're breaking through a level, we get 3 5-minute candles or more below, we retest our level, we enter short or puts, you're targeting the 1.272 level, that's your exit on the trade, right? But unlike retail, let me just erase a little bit, we're getting, retail's getting, sorry, there we go. Retail's getting this, we'll say 5.3 points. I guess we can also kind of refer to ourselves as retail, but we're going to go with, we're educated retail. We're getting 10 points to their 5.3, right? An example of where this failed is if we go to our daily SPY, there's a massive bear flag. And I've talked about this, so some people might already know where I'm going with this. But I'm hoping that people that didn't see me talk about this are going to know what I'm saying. I don't remember what time frame it was on. It might be on 5 minutes. Yeah, so 5 minutes. Let's just click replay and get rid of that information. This is our bear flag, right? So if we draw this, something like this, right? What is the distinction between this bear flag and the bear flag that we were just looking at? I'm going to answer it in just a second, but I'm giving you guys that aren't watching this live a chance to think about what's different on this versus the last one we were looking at. And then I'm going to give the answer. I'm not going to wait for you guys to answer that are watching this on a delay. But basically, what we were looking at before is a bear flag. Like if we were to draw this same bear flag, where this is the top of my flag, this is the bottom of my flagpole, this is the bottom of my flagpole, and then this is the bottom of my flag, and this is the top of my flag, right? And what we're looking for is for price to come down, spend at least 3 5-minute candles below our level, retest it, and then we enter short, and we would be targeting the 272 level. So we're actually looking for that, right? On this bear flag, we formed it above a very key level, the 2024 value area high. And then if we step this forward, they just duked retail, right? They sent it flying from there, right? So if at the close or whatever on Tuesday you're like, oh, they're going to slice through this, and if you happen to know, you know, like that your target is the 272 level, like you're grabbing whatever 554 puts on SPY, and you're thinking, oh, they're just going to dump this, you know, between Tuesday to Wednesday, and then you get stopped out. We're looking for bear flags to be formed below key levels, and we're looking for bull flags to be formed above key levels, right? So this was a big old fake out. I saw it. Like, I was like, oh, they're totally going to fake out retail here. I could go back to Discord and find the exact message where I was talking about it and pull it up on screen for you guys, but you guys can also just take my word for it. I have no reason to lie, but I saw this, like, I was like, oh, they're about to screw over a bunch of retail traders that are like, oh, we got a massive bear flag here. They're going to dump this, blah, 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 but they formed it above a key level. And that's the issue with this. And that's why they reversed it and went higher and stopped out retail. The only thing they didn't do is they didn't come below and then go. But again, like if you got in puts, you know, at the end of the day thinking they're going to do it overnight, you got killed. So let's go back to our chart here. So we're looking for this to happen below key levels. And again, it doesn't even have to be a bear flag or a bull flag. And I'm saying below key levels. It's not just below key levels. We're also looking for breaking above a key level, 3 5-minute candles or more, retest, enter long or enter calls, right? And then, sorry, I'm not ignoring you guys. I got to say big thanks to Daryl for the donation. Appreciate that, brother. And a big thanks to Melanated for the donation as well. Appreciate that as well. You can enter based on fibs, and let's see. Let's just grab like this here. I don't really trade this way too much, and I don't know that that's going to work. Yeah, it's not. Let's see. Well, it doesn't matter. I mean, we could show an instance where it doesn't work, I guess. Generally, I mean, so like we wouldn't be entering here because we're drawing from the bottom here. We're looking for a retest of like our golden pocket, which is the 618 level and the 682 level. So generally, they'll give us reversals in this area. And so basically you choose your range. This is why I don't trade this way, is because it's very subjective. Like somebody might be like, oh no, you draw from this point to this point, and somebody else is like, no, this point to this point. Or maybe if I drew from this point to that point, then they do reject right in the golden pocket, which they did. Or if I draw from this point to that point, then they definitely reject it in the golden pocket, right? So, yeah, if you grab like whatever, even like the new higher high to the lower low and took puts in the golden pocket here, you were golden. And then also if you recognize that we have a poor low here, so we're probably going to go lower, so on and so forth. But I don't trade this way, so I don't want to be teaching this because it's not something that's my forte. It's not something that I'm like great at. If you want to learn fibs, I would say go and learn from the stud. Shorty did a class on fibs just one time. I'll link it right now. But I am not the person to be teaching fibs. And I will say, like, I mean, most of you know this. I don't sugarcoat anything. I don't lie. I won't tell you that I'm good at something if I'm not. I'll be the first person to be like, I suck at fibs. I need to take the time to actually get better with fibs. I do have like a good understanding, you know, of like measured moves using fibs and to close at the 272 level. But beyond things like that, like I really don't use them to find entries. I don't really trade too often off of the golden pocket or things like that. I did use them on Friday. I used fibs for an entry. I might be able to show you guys if I can remember what the trade was. I think I drew, and I might be wrong here, but I think I did this. Yeah, no, that's wrong. Or maybe it's not. And then I also drew a fixed range volume profile. And I was kind of telling people when I was trading live, I was like, right here, we have a volume shelf and the golden pocket. And so when we come back to here, it might not be a bad place to grab a short. And basically, you know, if you took it, it wasn't terrible. It was a pretty decent trade. And then here we have like a strong low, so you'd want to close, you know, before we got to that. But so I did use fibs on Friday to trade, but it's not something that I do very often. Okay. But the link I just posted on Shorty's class on fibs, second to none. But again, fibs are just not like something I'm super strong at. And so I don't want to be trying to teach something that I really don't know like super, super well. Because I might mislead you guys, and I don't want to do that. The next thing that I really want to talk about is going to be the 80% rule. So we've kind of talked about, or not kind of, we've talked about trading off of SR flips. We've talked about volume shelves. And I think there's one thing that I should like really be clear about with like volume shelves. We were talking about like if you have a volume shelf like this, price can hang out through here, right? The one thing we didn't talk about, which you can kind of see here, so let me erase this volume profile here. Generally, when you're looking at a volume shelf, price will generally go from one side all the way to the other side of the volume shelf and then reject. So like if you're in calls and you see like price coming up to a volume shelf, just know more often than not, you're not going to reject at the beginning of the volume shelf. You'll generally go to the far side of the volume shelf and then reject from there. Okay? Or if you're looking to enter a trade like based on a volume shelf, like you're generally going to want to get in at the far side, not at the beginning. Okay? So the next thing I want to look at is hopefully this will be what I drew. I don't think it is now. Ruh-oh. Is it ESM? Hopefully this is it. 30 minutes. There we go. So I'm specifically showing this example because I want to talk about the 80% rule, and I also want to talk about a little bit of psychology while I'm talking about the 80% rule. So what the 80% rule is if we go to like a 5-minute chart here. Okay, I'm just making sure I'm pretty sure I looked at this really close, but we're looking at previous week value area high, previous week value area low, and we're looking for, after this is formed, and actually I don't think these were weekly levels, they're daily levels, but it doesn't really matter. I think I just chose the wrong thing. So we're looking for price. Actually, it's here, sorry. Is this? I could be entirely confusing myself. Yeah, actually this is it right here. So based on our previous day levels, we broke above our value area high. Actually retested the top, and then if we're like really like breaking this down with analysis, we have a poor high here. So when we broke above, had our 3 5-minute candles or more above, retested, we expect price to break through here and go higher, right? You would have to like figure out, you know, where you want to close your trade based on before. But I'd probably be looking at something roughly like this as a place to close. Again, just looking for key support levels, turn resistance, and then that would be where I would want to close. It would be early based on this, but again, I'm perfectly good with that. But that's not really what we're looking at. But good to recognize we have a poor high retested, you know, and went and made a new higher high. What we are looking at with the 80% rule is we want to spend 45 minutes above or below our level, right? And when I say 45 minutes or more, but a minimum of 45 minutes. And I'm going to draw it from both perspectives. So basically, we're looking for 45 minutes or more above or 45 minutes or more below. What we're seeing here is basically like, in this instance, aggressive buyers were trying to push price higher, but they weren't able to, and we failed and came back inside of our value area. What we're looking for again is at least 3 5-minute candles below, retest, and this would be our entry for shorts or for puts, right? When you're doing a trade like this, what the 80% rule says is if we spend 45 minutes more above and then fail and come back inside, retest, there's an 80% chance that we go from one extreme to the other. And that works both ways. So if we spent 45 minutes below, came back inside, retested, 80% chance that we're going to the far extreme. So either value area low to value area high, or value area high to value area low. But one key thing to know is once this plays out, so like if we're looking at the previous day, if we explore from high to low, the 80% rule is done. So like if we came and spent 45 minutes below and then came back inside, we're no longer looking for 80% from low to high. It's already played out once, right? And this would be on any time frame. So like you can get 80% rules on yearly charts or yearly levels. You can get 80% rules on daily levels, weekly levels, monthly levels, so on and so forth. The reason I'm showing this specific example, and we're going to talk about some psychology, we broke inside, had our 3 5 minutes or more below, retested. This is where you would enter puts and or shorts, and we're targeting the previous day value area low. If I and actually, I want to undo what I just did. There we go. If I'm taking this trade, I'm going to be looking at a few things, right? I look here and I go, okay, here I have a poor high. If I'm taking this trade, I need to draw my short position. And this might seem crazy to some of you, but when I see price break below like this, I have at least 15 minutes to plan out my trade. So you have plenty of time to say, this is my entry, this is my profit target. Those two levels are easy to find, right? Then the issue is, where do I put my stop loss? I always look at, like previous information, previous levels. So my eyes go to like this poor high here, or my eyes go to like, again, resistance turned into support. If I'm, the poor high, I could say, if they break this, everybody should know what's going to happen, right? If they come, if I enter puts here and they do something like this and then come up and break this poor high, what's going to happen? We're going to go way higher, right? We're going to make a new higher high like we did here. So looking at this, like breaking above this poor high basically would invalidate my trade. And that would be if we didn't have this information here, because we already cleaned up this poor high. But let's just say there was a poor high and there was nothing above it. Knowing that if we break above that poor high here, that's a good place to close my trade and take a loss. Because if we break above the poor high, they're going to go and make a new higher high, right? Looking at like a key SR flip, something I was talking about earlier is, let's just pretend we don't have this level here. And I say, this is my key SR flip, and they come up here, do something like this. If they're trying to stop out the people that use this SR flip as their stop loss, they're going to go a little bit above it, and then they're going to make the move, right? So I would want my stop loss to be slightly above that, which in this case, we do have more information, which is this poor high. If we put our stop loss there, we're solid, because if they break through that, they're completely invalidating our trade. They're probably going to go higher and make a new higher high, right? So with that information, if we look at this trade, we're risking $1 to basically make 4. And based on what I'm giving you guys, I don't know that this trade worked out. And that's fine. But we're trading the 80% rule. And we're looking for this. So in this instance, it does work out. But one of the things that I want to point out to you is, if I... Oh my gosh, how much are you going to make me go backwards? I'm going to be a little bit aggressive when I say this. If I'm being a dipshit retail trader, and at any point in time, like I entered here, if I took this trade, and that's my long position, right? Short position. If I take this trade, and let's just say like I start getting freaked out, like, oh, I saw them come down here and they made a strong low, right? And so at that point, I'm like, let me just bring my stop loss down a little bit, right? So now, instead of having my risking $1 to basically make 4, now I'm like, if they come back up and touch this level, I'm going to get stopped out of the trade. If I do that, then I completely missed out, because they came in, they hit my take profit level. If at any point in this trade I trailed my stop loss, I'm gonna lose the trade, and I'm not gonna get the full $1 to $4 risk to reward. This doesn't make sense to a lot of people, but if I'm doing this, if at any time that I'm in a trade, and this is like one of the most important psychological aspects of trading, if at any point I'm in a trade and I don't go, wait, what happened? This was, I think I redrew this. Our stop loss was here, right? Close enough. Basically 1 to 4 risk to reward, right? In order for me to be able to move my stop loss lower when I'm green on a trade, then I have to move my stop loss lower when I'm red on a trade. Because, like, mathematically, as a good trader, I want to be making a minimum of $2 for every dollar I risk. But if I keep, trailing my stop loss, I'm not really risking $1 to make two, right? Because there's a chance if I trail my stop loss at any time. I mean, if we look at this, and again, I specifically used this example where we went, on our entry, we went red a little bit to green, back to red, back to green, basically break even to green, almost break even again to green, to red, to green, to even deeper red, green, back to break even, blah, 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 so on and so forth. Pretty deep green to, losing quite a bit on the trade if we were closing, so on and so forth, and finally hit our take profit level. You have to be patient and let your trades play out. If you don't, what ends up happening is, like, if I trail my stop loss, like, let's say best case scenario, I'm like one risk, one reward because I trailed my stop loss. So now, like, even if I'm like a 60% win rate trader, I'm barely making any money after fees. Because I'm being stupid and I'm making $1 for every dollar risked. At one risk, two reward, you only have to be correct like 34% of the time and you're going to make money mathematically. It would be a similar scenario to like your 60% win rate with one risk, one reward, but the odds are way more in your favor if you're doing one risk, two reward and not having to have such a high win rate. Electros, so I said any value area, so like previous day, previous week, previous month, previous year. So this is really, really important. I really don't know like how to hammer this home more than what I am, but we really can't be trailing stop losses. What happens, and I'm sure everybody can probably relate to this, when we get into trades, we'll go, like we'll see a really nice setup, right? And then as soon as we get into the trade, we'll start going, like, let's just say at this point here, like, oh, I was pretty green. And then it went to red. And then to green. And then we made a strong low here. Like, this is scary. So if there's a strong low there, there's a good chance that next time we come there, we're going to bounce. Maybe I should just close this trade with this strong low here. Like, maybe we're not going to make it to the previous day value area low. And so as traders, when we're in an active trade, we start second guessing everything. We start looking for every single reason to close a trade. Oh, like, look at the volume that just came in on that candle. There, like, we have, whatever, just, I don't know, like, pick your poison. Oh, they just formed a bull flag. Like, what if we send it up and da-da-da? Like, you start looking for every single reason you can possibly think of to close your trade. And if you're trying to be very disciplined, and this is really what I'm going to recommend for everybody, this is like, if you ask me if there's a way to say, if you want to go from being a complete noob as a trader to being a really good trader and you want the steps to do it, this is it. Every single trade, one risk, two reward as a minimum. Every single trade, no trailing your stop loss. So you enter your trade, you put your stop loss wherever you feel it needs to be based on the information that you have. You put your take profit where you think it needs to be based on the information that you have, and then you let the trade play out. You're only playing your key levels. Are you going to get stopped out way more than what you're currently doing? Where, when I say currently doing, I'm just kind of assuming most people don't trust their levels, and so they'll start trailing their stop loss because they're so worried about taking a loss. And let's just say, like, right now you're an 80% win rate trader, but the issue with your 80% is you're only getting 50 cents for every dollar that you risk. And the reason you're only getting 50 cents is because you're trailing your stop loss. So even at an 80% win rate, you're actually losing money, right? Well, let's say you switch your trading style and you stop trailing your stop loss, and now you're a 50% win rate trader. But since you're risking $1 to make 2, then, mathematically, you take one trade. Let's say you take a loss. So right now you're -1, right? Let me just pull up a calculator here. -1. Can I do that? Yeah. And then your next trade, you win. So you're up $1. Your next trade, you lose. Now you're break even. Your next trade, you win. Now you're up 2. And then your next trade, you win. Now you're up 4. And then your next trade, you lose. You're at 3. And then your next trade, you win. And now you're at 4 again. And then your next trade, you win. And you're at 6. And so on and so forth, right? This way, mathematically, you're profitable with a lower win rate. This way, you're losing money with a higher win rate. So we need to switch to this. And then, of course, our goal in doing this is to increase our win rate, right? How do we increase our win rate? We're absolutely going to get into that. What you're going to do is you focus on your setups. You look for only key, like A++ setups, where you're able to make sure that you're making $2 for every dollar you risk. You're waiting patiently for the setups to come to you, and you start by doing only one trade a day. The reason we do one trade a day, and I kind of always just like compare this to if I'm in a life or death situation and somebody's trying to murder me and I have a gun with just one bullet, right? I am going to wait until 100%, without any questions, without any doubt, the person that's trying to kill me is in my sights and I can get a kill shot on them, right? If I have a gun with a 30-round clip and somebody's trying to kill me, I'm just going to be like, okay, and like just take shots here and there and hope I hit them, and maybe things work out, and I hit them right in the heart and they're dead, and now they're no longer a threat and they can no longer kill me. And with that 30-round clip, like I might take 20 shots and I haven't hit them at all, and I'm like, ooh, like I better slow down because I need to make sure I've got them in my sights, make sure I put them down before they kill me. So if I'm limited to one trade a day, one bullet, I have to wait really patiently until that trade is dead in my sights, right? Which is, in this instance here, that one shot is this retest, right? The issue with having 30 trades is people will be like, I can try a short here. And if it doesn't work out, it's okay because I can just take another trade and I can make back the money that I lost. And then you lose that trade and you go, let me try another short here. It's okay because even if I lose a second time, I can take another trade and I can make back both trades that I lost. And then you go, let me take another trade here. Let me try long because I tried short twice and they stopped me out both times and they kept going higher. So let me just try a long. And that way I can make back both of the trades I just lost. And then guess what? You're the person that just lost your entire 2 weeks that you were winning. And you just blew your entire account in one day because you kept going, I've got 30 of these trades. It's not a big deal. Like one of them's going to hit. And that's not what happens. As we take more and more trades, we get more and more frustrated. We're less patient. We're less disciplined. We're not looking for good setups. We're just like, oh, they keep going down, so let me short. And then, of course, you happen to get in when they decide to reverse it and go long. If you're limited to one trade a day, you're forced to be disciplined and patient and wait for that good A++ setup to take your trade. What's up, Nora? How you doing? So that's the purpose of our one trade a day, is it's forcing us to be super disciplined and super patient. This is super important. And you have to hold yourself accountable. And some people will try to figure out ways to like manipulate the one trade a day. Like, oh, like I'm going to take one future trade and one options trade. No, you're taking 2 trades. While you're doing this, you need to take one trade a day for 6 months. Ches, I'll talk about that in just a second. So, one trade a day for 6 months, key levels, wait for good setups, 1 risk to reward every single trade. The next thing is going to be we want to look for setups when the market's closed, right? So how we do that is we chart our levels, and let's just say, like up here, I know I have a strong high. If price comes back to here, I know I want to be short, right? So then I would figure out, like, based on being short here, I'll put my stop loss, at the, I don't know if you guys can see where my cursor was, but basically here I have resistance. Yeah, I have wicks that break through it, but that's a pretty key resistance level. So if I can have my stop loss slightly above that, and then I'm targeting whatever, like this is one trade setup that I'll take. If they give this to me on Monday, if price comes back up to the range of this strong high, I'm going to be in short or in puts targeting my previous day value area low. And you just go through the entire chart and look at the information that's available to you, and just start figuring out, like, okay, here I would want to be in long, and I would target whatever the previous day value or the previous day POC, and this looks like a good place to stop out because this is a poor low, and if they go below that, they're probably going to go much lower and invalidate my trade. So something like this, and you're getting 3.5 to 1. And so when the market's closed and the candlesticks aren't moving, we figure out all of the entries that we're looking at for the next day. When I say this, and this is available to anybody in Shorty's Discord, so anybody that's there right now listening, if you want to join, just send me a DM or whatever. But I have like an accountability group where every single person in here is doing one trade a day for 6 months. Every single person in here will post the setups they're looking for the next day. And you can just do that with a screenshot, whatever it is. The one thing that they're able to do is, let's just say, like, I don't have this information, right? We're looking at Thursday to trade Friday. And so, like, all of my entries are like short here, long here, whatever, or puts here, calls here. And then they come and they gap down, right? And so, sorry, let me do this. So now I'm like, wow, well, everything, I was looking for shorts up here and I was looking for puts here, but price is way down here. Sure, at this point in time, you can go, hey, like, if we break above, 45 minutes outside and break above, get 3 5-minute candles or more, retest, then I can play to the previous day value area high. That would be the 80% rule. As long as you take the time to plan out your trade and say entry here, stop loss here, take profit there, blah, 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 you know, whatever it is, and you're able to get $2 for every dollar you risk or more, then you can take the trade. So looking at the charts when the candles aren't moving is a lot better, because once the candles start moving, then we get like the candles moving changes the way that we think. So it's really good to look at the market when it's closed and figure out entry, stop loss, take profit, whatever else. But if they do something like this where they gap majorly and we didn't have any trades planned down at those levels, then you can start planning out trades, as long as you know you're using your senses and being sensible, and not just like randomly like, oh, like I could grab calls here and, you know, maybe I'll get my 2 risk for my, or my 1 risk for my 2 reward or whatever. No, you need to actually plan the trades out. Okay. So, 1 trade a day, 6 months, 1 risk, 2 reward minimum. Plan your trades the night before, or before the market opens. Again, if there's some major gap in price, then you can start replanning at the new levels, you know, based on what you're seeing. I would say if you're really smart, like if you're not in Shorty's Discord, then when I say this, like I'm not trying to be a dick. I'm just like I just make that accountability group available to people in Shorty's Discord, because I don't want it to become overwhelming to me. If I opened it up to more than that, there would be like hundreds of people in there, and it would be too much for me to manage on my own. So I only make it available for people in Shorty's Discord. But if you're not in Shorty's Discord and you don't want to join Shorty's Discord, that's fine. I would recommend you find a buddy, or find a few buddies, make your own little private group, and you guys hold each other accountable, where every single night or before the market opens, you post a screenshot of what you're planning on trading, and then you guys hold each other accountable. And then like you could even meet like after the market closes every day and be like, hey, this is the 1 trade I took. And you know what? Today I'm so proud of myself. Like I took my entry, whatever, price did this, they ended up stopping me out, but I never moved my stop loss, right? Or I took my entry, blah, 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 blah. It went slightly red for a little bit, and then went down and it hit my take profit, and I never moved my stop loss. And I'm so proud of myself. And like, it feels so good. I'll tell you what, the very first time you take a trade, and especially like the uglier the trade is, right? Like, let's just say, let me draw like worst case scenario example. If we're trading this 80% rule, like, let's just say, I get in short right here, and my stop loss is right there, right? And then my take profit obviously is going to be previous day value area low. And like, there was a point, and I'm gonna use some actual math to like give emphasis to what we're looking at. There was a point on this trade where I was up 25 points. And if we do some math, I'm not good at math, so I have to use a calculator. 25 times 50, I think it's $1,250. If I took 1 contract of ES, I was up $1,250 and came a butt hair away from getting stopped out. And then from there, just jump, went all the way down, hit my take profit. And instead of like being a, and when I say this, like, I'm not trying to insult anybody, but instead of being a bizatch, I trusted my levels. I took my trade. I could have closed out with $1,200 profit, but instead I took the entire trade, and I think I made $3,500. Yeah. Right? And if at any point, like I said, if I trailed my stop loss at all, this never would have worked. But the moment something like this happens, where you're literally like, your levels are so dialed that you're like so close to being stopped out, and they reverse from there, and then they go and hit your take profit level, like, you are going to feel so good inside. You're going to be like, I trusted myself. I trusted my levels. I was up $1,200 and it went all the way to almost stopping me out negative 350. And then it went and hit my take profit for 3,500. And in your heart, you're going to feel so good. There's going to be times where it's going to do this and it's going to stop you out. And yeah, it sucks, but that's part of trading and you just have to take it on the chin. I think the best trade I ever took in my life was like, I'm going to NQ because it was on NQ. And I would say this is roughly like good enough as far as the move. It was like roughly 120 points. So this might be more. I don't really remember the exact amount. But I took my long here. And at first, like, you know, and it was actually a short, but we're looking at a long scenario here, so we'll just do this. It came up and literally went like this and then came all the way down to where I was like pretty deep red. And then it went doot, 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 bink, and hit my profit target. Best feeling ever. It wasn't the best feeling during this. But when it hit my profit target and I was like, I trusted myself, I trusted my levels. You know, like I didn't get scared when I was almost at my profit target and I'm like, you know, up XYZ amount of dollars. I never trailed my stop loss. And then when it was red, when I was red on the trade, I'll tell you, like I was like, I don't even remember, like maybe 10 points away from my take profit when it reversed and went all the way red. And for a minute, I was like, I'm the biggest dumbass in the world. Like, how can I be so stupid? I was 10 points away. I'm up like 90 or whatever, 110 points. How could I not just take profit? You know, like how stupid am I? And then it went in and hit my take profit. And I was like, yeah, I'm not stupid. I'm good. But the bottom line is if at any point, you know, during that trade, like at what point do you go, oh, I'm dumb for trailing my stop loss, or I'm dumb for not trailing my stop loss? You just have to trust your levels. There's going to be times that suck where you're up 90% of your trade, you're 10% away from your take profit, and it goes and it stops you out. But more often in scenarios like that, you're going to hit your take profit level. So there will be times that it does suck, but for the most part, it should work out in your favor. So to reiterate, one trade a day for 6 months, no trailing stop losses, entry, stop loss, take profit only. Find your setups before the market opens. Or again, if the market gaps, you know, large in one direction or the other and you don't have levels there, or I should say you don't have setups marked at those levels. Hang on, I'm going to close my window really quick. There's like a gardener right across the street or something. Then you can draw, you know, entry, stop loss, take profits at those gapped levels. One thing I should mention when I'm thinking about it, when we do have a gap like this, areas that you would normally be looking at as areas, like let's just say, I'm just going to draw a fake scenario, but let's just say I have single prints here, which I know I haven't covered single prints yet, but we will. Normally, if I have single prints, I would be expecting price to come down to there and then bounce. But when we have single prints that we gap through, you actually expect the inverse reaction. So like when price comes up to it, you expect a rejection down. Or if we had single prints at the top and we gapped over it, and we come back to those single prints, you would actually expect them to bounce off of it. Okay? Sorry, I kind of lost my train of thought for a second, but I'm just going to reiterate everything. One trade a day for 6 months. One risk to reward as a minimum. We're only looking for entry, stop loss, take profit. We're not trailing our stop loss. There's no levels in between. And one's, well, actually, no, I'm not even going to say that. Look for setups when the market's closed. And then the last piece of the puzzle, and some of this you might think that's the stupidest thing I've ever heard. Like, how's that going to help me become a better trader? All of these things that I'm saying, every single good, like, professional trader that I know, whether it be they trade for a living, or every single trader that I know that's very successful, has done every single one of these steps that I'm telling you. And the last step is journaling every single trade. So if I take a trade, let's just say, I'm going to give you guys an example. 80% rule comes up, entry, blah, 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 and then stops me out. I go to my journal and I start journaling my one trade of the day. And this should take you about 15 minutes. You want to really just like pause and reflect. And actually, like, I'm going to add something to all of this. When you're studying, when you're reading a book, when you're journaling or whatever it is, if you have a tendency to grab this thing every 5 minutes and like, oh, like, let me just check my notifications, or, oh, like, somebody texted me, or, oh, whatever. All of those distractions are going to prevent you from actually like studying or from actually focusing on what you're doing. So like picking up a book, sorry, I'm trying to find like a book that's close to me, but I have some, but I don't want to dig through all my crap again. But let me just say, like, I pick up my book. Okay, this is now a book, and I'm like, you know, like, oh, Drew said I got to read this book, and you know, whatever, blah blah blah. So let me try to get through it, right? So I'm gonna read a couple pages, and then my phone makes a ding sound, ding. So then I pick up my phone, and I'm like, oh yeah, whatever. And I gotta go back to reading this book. Ding. Pick up my phone again, look at it, so on and so forth. You're not effectively studying. You're probably just wasting your time. If you don't have the discipline to not pick up your phone every 5 minutes, then what you want to do when you sit down to read is put your phone on silent and put it across the room. Because if it's close to you, like, and you have that habit of like, oh, let me just check the time. Oh, let me just check this. Oh, let me see if anybody texted me. You know, whatever. Let me see if my girlfriend called. Blah, 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 whatever. You're never going to really effectively study. So just literally turn your phone off, put it on silent, and put it across the room, put it in another room. And if you don't have the discipline to like not touch it if it's across the room, then give it to like your wife or your girlfriend or your boyfriend or your husband or whoever it is, and tell them, hey, don't let me touch my phone for 30 minutes. And I'm going to study for a solid 30-minute period. That's how you effectively study. So same thing when you sit down to journal. You want this to be like something that you like actually are making important and trying to do properly. And so when you sit down to journal, you want to go, okay, entry, you know, whatever, $5,887.50. Price target, $5,000, 817. Stop loss, blah, 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 blah. Took the trade, you know, whatever. We spent 45 minutes above the value area high, broke back inside, spent X amount of minutes below. On the retest, I entered short. And then price went and stopped me out. I've looked over the charts. I don't see anything wrong with my entry, my stop loss level, and my take profit level. Probabilities just played against me. Blah, 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 blah. And then to go a little bit deeper, you go, what did I do right in the trade? Well, I was really patient. I waited for, you know, the retest of this key level. before I entered the trade. What did I do wrong in the trade, or what could I have done better? I was scared they weren't going to quite come to my entry level, so I entered a couple points early. And if I was patient, they actually would have given me the entry that I was really looking for. So you want to really reflect on what the factual part is. Like, this is the trade I took, this entry, this stop loss, this take profit. And then you want to focus on what you did correctly. And then you also want to focus on what you could have done better. So like if there was something that you did, like you entered early because you were worried they weren't going to quite come back to that level, what you could have done better is been patient and wait for them to retest your level and not get into the trade early, so on and so forth. And so you really want to reflect on every single trade that you take, what the actual facts were: entry, stop loss, take profit, trading based off of the 80% rule. What you did wrong in the trade, or what you think you could have done better, and anything that you think that you did correctly. And the reason for doing this is then over time we'll start to see like, hey, when I take trades based off of this, I only have like a 30% win rate, so maybe I should stop taking those trades. And every time I take a trade based off of the 80% rule, I have like an 85% win rate, so I need to keep taking those trades. And I recognize like I was doing this, and if I tweak that, I could do this a little bit better. And then you implement that into your trading, and now like trades where you had like a 60% win rate are now like at a 75% win rate. So taking the time to actually effectively journal and focus on what you're doing right, what you're doing wrong, what you can do better, will really help you elevate your game and get better and better and better every day as a trader. And really, like, the goal should just be 1% better every day. It might not sound like much, but those 1% keep adding up, and then soon you'll just be crushing it, right? Sorry, where was I going next? Okay, I know where I'm going next. There's a few ways that you can journal. If you just go to Google and you can type in like if you go to, and how you word this will depend on what you're trying to do. If you're a futures trader, you type in futures trading journal, and then the keyword is Excel. You want a digital journal. You don't want a pen and paper journal. And then you click on shopping in Google, and like you'll see here, there's a futures trading journal for $3.75. You'll probably also find some for $55. And then you find one that you think is going to work for you. There's a bunch of them, a lot of different prices. And like, I know this is a good one here, like $5.59. And maybe you try like, 4 different ones. As long as you're buying the cheap ones, they're not too expensive. And so get an electronic journal. There's another thing that you can do, which is you can just trade right on the internet. There's this Stonks journal, which is actually completely free. It's a free and ad-free trading journal. And basically all they do is they ask for donations. But it's not mandatory. You can use this journal for free. And it's a great journal. The other alternative is TradeZella. This is the journal that I use. It might not be for everybody. It's not cheap. So like I have a annual subscription. It's $400 for a year. The reason that I prefer, well, you can do the basic. the premium allows you to have up to 20 accounts. Basic just allows one account, and I trade on more than one account, so I have the premium. The reason that I use this versus using Stonks Journal is just, I mean, basically what I would say is, like, if $400 is a lot of money to you, don't go this route. If $300 is a lot of money to you, don't go this route. The reason I go this route is directly from my broker, I can download, what is it? I'm trying to think of the type of file, CSV file, and I can upload it directly into TradeZella, and it'll import my trades for me, and then I can just journal, my actual text stuff that I'm going to put in. You can also add screenshots, and you can do that, I'm sure, with Stonks Journal as well. You can definitely add screenshots to a Excel journal. So, like, you can add screenshots of the actual trades or whatever if you ever want to look back at them. TradeZella automatically puts a screenshot for me. But so it's just a little bit quicker, just being able to upload my trades, and then I just type in, whatever my thoughts were on the trade, and then what type of entry I took the trade off of. But obviously, like, this is premium, it's expensive. But if this is a lot of money for you, use one of the free ones. You're just going to have to type in numbers, right? Like entry, blah, 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 stop loss, blah, 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 take profit, blah, 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 blah. Whereas I just import that and it's all automatic. But you pay for what you get. You know what I mean? But choose one of them and journal every single one of your trades. So Ches asked, should we use footprints to confirm reversals entries? No. When you're first starting out, I would say, and we still need to get into one last part of the puzzle of trading, which is going to be our single prints, our TPO and our SIGs. But for the first few months, so like, let's just say you say, okay, tomorrow or whatever, Monday, I'm going to start my one trade a day for 6 months. When you start your one trade a day for 6 months, also start only trading off of volume profile, TPO, and SIGs. When you feel like you're deadly trading off of only TPO, SIGs, and volume profile, then you can add in your footprints and order flow. Because when you first start, footprints and order flow it's like, it's too much information where you're going to start second guessing and like, let's just say on this trade here, you're watching it and price comes up to here, and then you see like a bunch of buyers coming in, and you're like, no, like, it looks like a good setup based on volume profile, but based on order flow and footprints, it looks like we have more aggressive buyers coming in here, so I'm going to skip this trade. And then, of course, it goes and works out. So until you've traded one trade a day for, I would say, at least 2 months, possibly 3, using only volume profile, only SIGs, and only TPO, then you can start adding in the more pieces of the puzzle with with things like footprint charts and order flow and stuff like that. Okay, so start out with like more basic, and then add in the more advanced stuff, the more confluent stuff, after you really feel comfortable trading with just your SIGs, TPO, and volume profile. And Free asked me a question. Can I explain the single prints gap thing again? Oh, I was so confused for a second. It's not just single prints, but like, let's just say we have a level here that's single prints. Actually, let's do this because this is a single print. right? And normally, with single prints, we would expect if price comes back to here that we're going to sell off from there, right? This would be our normal scenario. But let's just say over the weekend they gap spy, right? And so now when we come back to these single prints, we would actually expect the inverse, which is we kind of expect a bounce off of here. This would become like a key SR flip. Okay. All right, perfect. Let me just take a look at chat really quick. I want to make sure I'm not missing anybody's questions. Sorry, Leo, can you be more specific about what you're asking? How do I choose my contracts regarding the time chart? Re-ask that question being more specific, because I really don't know what you're referring to. So, if you're not reading the chat, Shane's Trade says, one trade a day has gotten me multiple funded accounts / payouts. It works, but it's hard to do. It takes a lot of discipline to do one trade a day. But that's the whole point. Professor X, if you're asking if I recommend Trader Dale's book for reading price action, meaning the order flow, absolutely. Amazing book. But again, if you're not profitable right now, do what I'm saying where you're using volume profile, TPO, and Sigs for about 2 to 3 months. And once you feel like you've really got those things down, then you can add in your order flow and footprint charts. Okay. Sarah, I don't look at TPO live when I'm trading. Shorty does. And I do know traders that do watch it live. I just... for me, I feel like it's really cumbersome when I'm trading, and just like blocks my view. But that's me. It might not, like, I just can't see. So I don't like to use it when I'm trading live, but I do know a lot of people that do use it. All right. So we have a little bit more we need to cover. We're actually almost done. While I'm thinking about it, so I'm going to share another book with you guys. Or actually 2 more books. Oh, I linked the wrong book for volume profile. So sorry, let me link it again. This is the link for volume profile. This is a link which I'm really not going to talk about too much. I'm not going to talk about this at all, actually, but this book is called Volume Price Analysis, and it's basically just talking about volume at time versus volume at price. It's a must-read if you want to be a trader. And then the last book that is a must-read for what we're covering today is going to be Trading in the Zone, which is this next link that I'm sharing. And that's really just talking about the psychology of trading. But between those 4 books, so again, if you understand, chart patterns, uptrends, downtrends, sideways price action, you don't need to read this book. But if you don't understand those things, then start with Getting Started in Technical Analysis by Jack D. Swagger. If you understand those things, then the books that you want to read are going to be Volume Price Analysis by Anna Cooling, Trading in the Zone by Mark Douglas, and Volume Profile by Trader Dale. From there are more books to read, like if you want to get better and better and better. I'm not going to talk about those today because I don't want to give too much information and have people start getting confused. And I will add this. Nobody said this in the chat so far, but I always hear a lot of excuses like, oh, I'm not a good reader. Oh, like I can't concentrate. Oh, this. Oh, whatever. Blah, 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 blah. You will never hear me say this very often because I don't like excuses. But I'm just sharing this with you guys as an example as to why fuck your excuses. Excuse my language, but don't. Like, and actually, like, I have to kind of quantify this. I hear people say all the time, oh, I'm dyslexic. I'm like, oh, really? Have you gone and been tested by like an actual educational psychologist that is qualified to tell you that you're dyslexic? And they're like, no, I've never been tested. And I'm like, okay, then why are you saying you're dyslexic? Like you're diagnosing yourself. Weird to me when people do that, especially, and some people might not like what I'm about to say, but especially when women say I'm dyslexic, I'm like, are you sure? The reason being is dyslexia is way more common in boys and men than it is in girls and women. And so whenever I hear a woman say I'm dyslexic, I'm kind of like, are you sure? But for real, 100%, no questions asked, I'm dyslexic. Diagnosed, no questions asked. You guys probably hear me do it often when I'm like doing live analysis. Like I'll be looking at this number and I'll say 650. And I'm trying to say 560, or I'll even say like 650 or whatever. I do it all the time. And it's like a real problem that I have in my day-to-day life where I transpose letters, I transpose numbers, I'll even transpose entire words. So like when I'm reading, I'm just trying to figure out like a good example to show you guys. Like when I'm reading, I'll do opened we within. And I'm like, huh, what? And then I have to go back and reread it because I read it wrong. And I'm not saying that I mix up everything, Emily. Nines and P's and Q's, B's and D's. I mean, like it goes on and on. It's a good time. But the thing is, I mean, we just have to embrace who we are. Like we're all. I love 69. I mean, sixes and nines. Yes, I mix those up too. We all just have to embrace who we are as people, and all of us are going to have our quirks and our issues and whatever else. But the big thing is not to use them as excuses. If I was like, I hated reading so much in school that it affected my grades. So I'm sure that most of you can watch me talking and teaching and can say, hey, this is an intelligent guy. I don't talk about this very much because I'm not one to brag, but when they test you for dyslexia, they generally also IQ test you to figure out where you are intellectually. And people might not know this, but like Einstein's dyslexic. Some of the most intelligent people in the world are dyslexic. Some of the most intelligent people in history are dyslexic. They kind of go hand in hand. And so I have what would be considered a genius level IQ. I don't talk about that very often. I'm not one to like brag or, like talk about myself like that, but I'm just sharing this as like, for anybody that like is like, oh, I can't read, or oh, whatever your bullshit excuses, fuck off. Like, I don't want to hear it. I actually get really annoyed because when I sit down to read, and this, like, let's just say with somebody with no learning disabilities, you're going to read a page in 30 seconds or a minute. I'm going to spend 10 minutes reading that same page. And never once in my entire adult life, like as me trying to get better as a trader, have I gone to like my wife or somebody and been like, you know what, like I really want to get better as a trader, but it's so hard for me to read. Like I'll read a sentence and I'll have to reread it 10 times because I transpose words, and so I don't understand what I'm reading because it's all mixed up and jumbled. And I also have like trouble focusing. And that might just be like some BS. I don't know. But again, when I'm saying this, I'm not saying it to you guys as an excuse, because I've read all of those books, and I've read all of those books to the point that I really understand what was being said. But I guarantee you, if it took you 1 minute to read a page, it took me 10. But you will never hear me come in here and say, oh my God, it's so hard for me to read. I hate reading. Like, I just can't do it. Like, da 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 da. Fuck off. I'm actually getting a little bit emotional because it is like a real struggle for me. But I don't use it as an excuse. If I want to get better as a trader and I have to read a book, then guess what? I'm going to read some books. And when I hear people come in and start telling me like, oh, like, did it? I'm like, dude, seriously? Like, maybe there's a chance, maybe you have it as bad as I do, but you probably don't. And I just really don't want to hear it. Like, if you have excuses, then just don't try to be a trader. Go do something else. Pretty simple. But if you're being real with yourself, you are capable of reading a book. The only exception to that would be people that didn't learn how to read. Well, guess what? Now you need to go learn how to read, and then you will be capable of reading a book. But you don't have any excuses. A blind person can get books in Braille. Like, there just isn't an excuse. Yeah. And more importantly, I don't want to hear your excuses. Like, I really just don't. I'm here, like this class, we've been going for 3 hours and 11 minutes. I'm doing this out of the kindness of my heart. I'm not getting anything. I mean, like, I'm never afraid to show this. Like, let me see. I think a lot of YouTubers won't do this. I'm not afraid to. This is, if you guys consider the amount of time I put in every month, $361. Like, and then some of these days it's like $4 and, you know, whatever. Most of my videos, like, I'm giving an hour of my time. And so some days I'm making $4.50 for an hour of my time. I'm not doing this for monetary gain. I'm doing this because I want people to get better. I want to help people. Yeah, I'm not going to complain about getting $360, but I could make way more doing pretty much anything in my life. Like, I could pick up extra shifts at work if I needed more money. I could focus on, you know, like that hour that I spend here teaching you guys. I could spend studying, or whatever. I could choose a side hustle and go and make more money doing that. Like, it's not about monetary gain for me. These 3 hours and 15 minutes is the kindness of my heart, trying to help people get better. I'm going to add this, and this, I was going to say this before you said this, Robin Hood, but I will say, like, audiobooks are not terrible, but they are also terrible. So, like, if, let's just say you want to listen to Trading in the Zone every single day, driving to and from work, and you're in the car for 2 hours a day. Sure, that's a great use of your time, to spend, like, listening to an audiobook. But when we listen to audiobooks, we're not really focused on the information. When you sit down to study and actually read a book, you can't be doing other things at the same time. Whereas I can listen to an audiobook and drive the car, or clean the house, play with my kids, you know, just whatever. Like, and generally when you're doing like an audiobook, you're not really focused 100% on the audiobook. Whereas if I'm reading a book, I have to be focused 100% on reading that book. The other thing, and sorry, I'm going to reach over really quick. I got to grab something. When you study, what you can't do if you're driving a car is you want to take really detailed notes. And so like you can look through, I have so many notes as I'm trading, as I'm reading, as I'm trying to grow, very detailed, lots of information. It goes on and on and on. I have pages and pages and pages of notes that I take. And you can't really do that if you're listening to an audiobook and doing something else. Whereas if you're sitting down reading a book and you read something that you think is really valuable and you want to make sure that you really learn that and don't forget it, then you pick up your notebook really quick and jot it down in your notebook and take your notes or highlight it or whatever it is that you do. So that's how you want to read, is like, again, phone off or on silent across the room, or give it to your partner if you're not disciplined to still not touch it. Actually take notes. All of these things are really important. Okay. Yeah. So this is really like pretty much the entire class. The last thing that I want to talk about is going to be SIGs and also TPO. So these are important things. And then fortunately, like, we have good examples, right? So for SIGs, we need 2 or more days where our volume profiles are overlapping. So this here, Wednesday to Thursday, is a great example of 2 days where our volume profiles are overlapping. And then Friday, our volume profile is also overlapping. So from the low of Thursday to the high of Friday, this is the portion that's overlapping, right? But if we look at Tuesday to Wednesday, we have a gap here between the high and the low. So we can't use SIGs on these 2 days, but we can use SIGs on these 3 days, right? And then also, like, from Monday to Tuesday, we can't use this because we have a big gap, right, from low to high. So these days are not overlapping. Friday to Monday is not overlapping. So we can't always draw SIGs, but when we can, we want them on our chart. And what we do is we figure out with session volume profile on 30-minute time frame for our daily levels. Thank you, Bummy. I really appreciate that. And also thank you, Nora, for gifting the membership. I appreciate that as well. What we do is we grab this tool. It's called Fixed Range Volume Profile. So FRVP, or you can type out Fixed Range Volume Profile. I have mine down here on this bar. And the way that you would do that is you have to figure out where it is. That's the hard part. But once you find it, or wait, maybe it's not here. I think it is. Yeah, here. If you put a star next to it, it'll put it on a little favorite bar for you. Okay. So we grab our fixed range volume profile, and we're going to go from the first candle of Wednesday to the last candle of Friday. And once we've done that, we turn off our session volume profile. That way we don't have all those extra lines in there. Thank you, Professor. I appreciate that. From here, we go to value area volume 68, row size 100. The settings are going to be the same, but I'm just covering them again. Value area high on, value area low, POC. Right? And then from there, we're going to go first SIG, And then from here, we change our value area to 95. And we already kind of talked about this. This is the bell curve, right? Our first standard deviation is going to be 68%. Our second standard deviation is going to be 95%. And right now you can see that my second sig basically lines up directly with my previous week value area low. So I'm just going to combine those two levels. And then at the top up here, my second sig. And then from here I go to value area volume 99. And then in this instance, my second sig is also my third sig, which you will see from time to time. And down here at the bottom, I have my third sig. And basically what we use this for is when we're in a bracketed market, meaning price is trading in a range, like let's just do this actually, like here. When we come to these extremes, we would expect a reaction, right? Most times you're going to see reactions at the second sig or the third sig, or down here, second sig or third sig. So it's just a key area that we're watching for reversals. It's another level on our charts. Okay. So anytime you can draw sigs, you want to. So like if we go to the 65-minute chart and we use our PVP indicator on the 1 week, these 2 weeks are overlapping, so we can grab our fixed range volume profile from Monday of this first week to Friday of the last week, turn off PVP, and go back to 68%. And then from here, we can go, draw a line. I'm not going to do this for all of these. But so then what I do, oops, what did I do? Is I go, weekly first sig. And basically, you would do all of your weekly levels, weekly first sig, weekly second sig, weekly third sig. Your daily sigs, like after Monday, you would erase them. And if there was 3 days in a row, if there's 2 days or more in a row on where your volume profiles are overlapping, then you would redraw your daily sigs. Your weekly sigs, basically you would remove at the end of the week on Friday. And then if you have 2 or more weeks overlapping, then you would redraw them based on the new information. From here, you can go to the 4-hour chart. And on PVP, we switch to the 1 month. And then you see we can't draw SIGs because we're way down here. Well, actually, March isn't finished yet. So we can draw SIGs based on the last 4 months, right? 1, 2, 3, 4. And then when March finishes, we would delete those monthly SIG levels. And if March happened to be overlapping with these, then we would draw SIGs based on those 5 months. Okay? Thank you, Ches. I really appreciate that. So hopefully how we find our levels. And then also, of course, like we go to the daily chart and on our PVP indicator, go to 12 months. And if we have, 2 years that are overlapping, which we don't, then you could draw SIGs based off of the previous 2 years. Okay. So that's SIGs in a nutshell. And then the last thing that I want to talk about is going to be TPO. and we've basically already covered this, but on TPO, we have, there's a few different things that we're looking at. And I'm just going to erase everything to get rid of the noise. So we can just focus on this. So we already covered this, right? This is, we didn't cover it in TPO terms, but this here is a poor low, right? We have the A and the B period at the same level, right? So what we expect when price comes to here is we would expect price to break through and clean up what is considered a failed auction, okay? There's one point, I need to bring this up really quick because I don't want to forget this. The last thing that we need to talk about is, and I might have just forgotten it. Oh, now it just came back to me. I'm just going to cover it right now so I don't forget it. I'm not going to forget to go over TPO. But this is a really important thing that everybody needs to understand. People will say, and I might trick you guys a little bit. In this scenario here, do we have more sellers or do we have more buyers? And I'm going to pause to give you guys a chance to think of your answer. And once you've thought of your answer, the answer is no, we never have more sellers than we have more buyers. We never have more buyers than we have more sellers. Since we're always dealing with bid and ask, the real question is, are buyers being more aggressive or are sellers being more aggressive? And this might not make sense to some people, but for any time that we're trading, if I want to sell my one SPY, I have to have somebody to buy it from me. So basically, anytime I sell, there has to be a buyer. If there's not a buyer, I'm not going to get filled. Anytime that I'm buying, there has to be a seller. Otherwise, I'm not going to get filled. So for every sale, there's a buyer, and for every buyer, there's a seller. And so there's never more sellers or more buyers. It's just who's being more aggressive. Like if I'm buying at the ask and everybody's buying at the ask or everybody's clicking market buy, then that's going to cause price to go up. If everybody's selling at the bid or clicking market sell, that's going to cause price to go down, right? So it's just who's being more aggressive who's more aggressive out of the market participants, and never is there more buyers or more sellers. Okay. Back to TPO. Sorry, I had to cover that really quickly before I forgot it. This we didn't talk about because this is like the one difference that you'll see like on TPO that we don't see when we're talking about like poor lows, poor highs, or strong highs, strong lows. This is a spike. This only happens on the M period. So basically, if this was any other time frame, if I turn off TPO, we would look at this and say this is a strong high. We would look here and say this is a strong low, this is a strong low, this is a strong low, strong low. Actually, sorry, this last one's a poor low. But normally we would say this is a strong high. But when it happens on the last candle of the day, at least on SPY, on futures, it's going to be the second to last candle of the day. Like if we go on a 30-minute time frame, this would be the M period on ES, and this is the N period. So futures are open longer. So if we turn on TPO here, you'll see, oh, we need to be on regular trading hours. And then zoom in like crazy. And then separate this. So you can see here we have an extra period on futures, so M and N. But still on futures, what we're looking at when we're looking is the M period. So like if we were charting ES here, this is our strong high. I mean, this would be our spike, sorry. And the base is going to be the L period. But we'll go back to SPY and do this. What I do is I can't see where the candle is when I have this turned on because it's not transparent. So once I have my M period marked, I just turn off TPO. And the top of my wick here is going to be my spike base. Okay, so the top of the L period is your spike base. The top of the candle is your spike. And what's different about this is we don't know who was more aggressive when this happened. So basically, all day long we were making higher highs, higher lows, higher high, higher low, higher high. And then the market closed, and we don't know if this was just like a little healthy pullback before they go higher, right? Because our information stopped here. What we know with TPO is if we open below our spike base, that most likely, and I'm drawing from here because like pre-market, whatever, they're still going to be trading in this range. In this scenario, if we open down here, then sellers were being more aggressive, right? So down here, this would be bearish generally if we open below this. I will say, like, if we open below and go back inside, this is bullish, right? If we open between the spike and the spike base, this is going to be a slightly bullish scenario. If we open above the spike, this is generally a very bullish scenario. If we open above the spike and come back inside, things turn pretty bearish. Okay? And then the inverse, if our spike is at the bottom, so if our M period was down here, it's the same information. If we open below the spike, it would be very bearish. If we open between the spike and the spike base, it would be slightly bearish. And if we were to open above the spike base, that would be slightly that would be bullish. Okay? So the things that we're looking at when we chart TPO is we could have single prints, which would be considered our strong low. Or we could have single prints at the top, which would be considered our strong high, right? We can have a poor low at the bottom, or we could have a poor high at the top. And then only on the M period, we could have a spike and our spike base. Okay? The very last thing I would say is when we have a poor low or a poor high, you want to look left and say, based on this information, where might we get a bounce? And if you look right here, like we have a little volume shelf. So if they bring price down to here, this is probably a good place to grab calls or get in long. Because generally with poor lows, they're not looking to go like a lot lower, but this would be considered a failed auction. And generally they just want to go low enough to clean it up and have a completed auction and then bounce. Okay. I'm going to pause for a second and just read through chat. If you guys have any questions and you didn't already ask it, now would be the time. If not, we've been going for just over 3.5 hours. And I think I've covered everything that I want to cover. But if you guys do have questions, please ask. Oh, wow, Shell. That's crazy. I'm just seeing what you said about your daughter. always shocked to hear about a girl or a woman that's dyslexic. Again, it's not unheard of. It's not impossible. Just way less likely for females to be dyslexic. Let's see, Alan. I don't see where to reduce the transparency. I see where you can reduce the transparency like above your value area, but not within it. Maybe I'm just like dumb. I don't know. Yeah, I don't see it. Oh, it's got to be here. Okay. Is it? Nope. Or is it that I have show volume profile? I don't know. Nope. I don't know. Maybe you can tell me. I don't see it. Oh, wait. I was messing with my volume profile settings. No, I wasn't. Oh, the actual color setting here. No. This, bro. Oh wait, no, that's the value area high. This. Maybe it's this. There we go. Alrighty. So I got to lower all of those. Cool. Got it. Thank you. No worries, Sarah. Yeah, I got it, Alan. Thank you. Leo, that's a pretty easy question to answer. So let's just go to an actual like trade I was looking at. CRM. Let's turn off TPO. Oh, wait, I'm on the wrong. Sorry, let's go to CRM on this. And for this, we were looking for puts, right? Puts below first trim, second trim, close. When I'm looking at something like this, what do I have turned on? When I'm looking at something like this, what I do is, let's just say my average daily range is 6 points. Does that more than cover this? Yes, I can take a day trade. If I was trying to trade, like, let's say from here to here, then I probably want 2 or 3 days out, right? Based on how long it would normally take me to travel that distance based on the average that price moves in a day. Okay? And that's how I do it. I'll just go to like, and I actually take it a step further. I'll just go to like daily candles and just kind of look for what I think the average is, or even like the lowest. Like if this is a small 1 day here, then I'll use this. Like, can I traverse this distance on one of the smaller days? And the answer is yes. And so I can take this as a day trade. If the answer is no, then I know I need like at least 2 or 3 days. Or you can even, like if you're looking for a bigger move, like let's say from here to here, then you can switch to weekly candles and say, like, if I grab, and again, I'm just grabbing like any example, based on a candle like this, could I make this move in 1 week? And the answer is yes. But then, like, if we look at a smaller week, like here, then the answer is probably no. And then I'm like, oh, I probably need like 2 or 3 weeks. So I just kind of try to look for the average size move and determine, like, based on that, can I make that trade? You know, can I get from point A to point B in 1 day? Yes or no? If the answer is no, then I know I need at least 2 days or more. If I'm looking for a bigger move, can I generally make that move within a week? If the answer is yes or no, you know, so on and so forth. And you can even go to monthly candles, 3-month candles, 6 months candles, you know, whatever, and figure out, like, if I grab a monthly candle, can I make this move in 1 month? And the answer is pretty much always going to be yes. So, like, on this trade, if I was trying to go from 269 to 285, I can grab contracts 1 month out and it'll probably hit based on that range. Okay. Thank you, Michael. Appreciate that. So hopefully that answers your question, Leo. That's how I do it, at least. Hopefully I've answered everybody's question. I haven't really been keeping up with chat too great. Robinhood, if it works, then keep doing it. I'm not trying to tell you how to do things, you know, per se, like, but for me, reading a book is the only way, but that might not be for everybody, you know. Do what works for you. My main point was just don't use whatever you have going on as an excuse. Oh, Robinhood, you're saying the one short I took on Thursday? You would have to give me levels because I don't remember. Corey, I'm just seeing now that you've got more jerky in the dehydrator. That's cracking me up, bro. That's awesome. All right, so I think I'm all caught up on charting. I mean, on the chat. Yeah, no worries, guys. Yeah, we're coming up on 3 hours and 40 minutes. I'm going to call it here. I hope all of you have a great rest of your weekend. Sunday, I'm going to go visit my mom, spend time with her and some other family as well. I don't want to give an exact time, but I think 9 o'clock tonight, 9 o'clock Eastern, I'll go live and we'll do basically, like, Shorty's going to be, he's in Colombia getting his Colombian nose candy and stuff. So he's on vacation for a little bit. And I can't wait for him to send me my care package from Colombia. But sorry, I'm joking, guys. I'm joking about the Colombian nose candy. But point being, he's not going to be doing market updates because he's on vacation. So I would say 9 o'clock Eastern tonight, probably. It might be earlier. It might be later. I don't want to make any promises. I'll go live and we'll do a market update on ES. And we'll also go over our normal SPY. It's going to be quicker than normal, though. Like, we're going to crank through it because doing both ES and SPY will take quite a bit of time. So we're just going to crank that out. Yeah. So I'll just close with what I think is the most important takeaway from this video. 1 trade a day for 6 months. 1 risk to reward minimum. Journal every single trade and look for setups when the market's closed. Those are like the make or break on becoming a trader. Make sure you get Trader Dale's book on volume profile and memorize page 25 through 45. Okay? With that said, much love, everybody, much respect. As always, huge thank you to all the subscribers. Extra big thank you to the people that chit chat. You guys keep things interesting. And also asking questions, generally helps other people that have the same question. So I appreciate it. Extra big thanks to the friends of the stream. And today, huge thanks to all the people that made donations. I really appreciate that. It means a lot. And if you're new, I know like these videos are not like professionally edited, and we're not using like crazy like, oh, the next stock to go up 1,000% or whatever. This is a real channel where we talk about real trading scenarios, where 5 days a week we go over analysis of what we expect SPY to do. I would say probably a few days a week we'll share option setups that we're looking at. And also about 3 days a week we go over analysis on ES and what we're expecting to happen with ES. And then once or twice a month we do classes like the one that I'm just finishing up right now. There's no paywalls. There's no Discord that we're selling. There's no course to buy. This is all like legit, real information and education on how to become a trader. And we're not trying to make money off of you guys. For people that don't know, I was very fortunate to be mentored by a market maker. He also does classes on my channel. And he's teaching us basically how to trade the things that market makers can't hide from us. And we're very fortunate to have that information available to us. So if you're new, if you felt like this was informative, I would appreciate a subscribe. If you didn't like it, peace out and good luck. I'm not trying to be mean when I say that, but there's so much fake crap out there, and scammers and whatever else, and people just trying to sell their Discord or sell courses and stuff like that. Just be careful who you're listening to. And like I said, I don't know, like halfway through this video, none of this information is new. It's all available in books, so you don't need to buy it from anybody else. Certainly, like, you can argue like joining Discords or hiring a mentor will help you get from point A to point B faster, but you can do it on your own for free or just for like the minimal cost of buying some books. Okay? So, as I always kind of say, just be careful who you're absorbing information from. Not to brag or whatever, but I feel like our channel is a good place to learn and grow from and get better. And like I said, you're learning it from a market maker here. With that said, as always, much love, much respect, everybody. I hope y'all have a great rest of your weekend. We'll see you around 9 o'clock tonight, Eastern time. Peace out. Much love, much respect.